from higher oil prices and deploy it into other assets. And looking to deals, again, it is the state-backed companies that are very much driving activity. We have ADNOC that's looking to list ADNOC Gas. There's ADNOC Shipping IPO in the works. And these are assets worth tens of billions of dollars. And the Saudi Aramco, of course. It was Saudi Aramco's IPO in 2019 that really sort of set off this listing boom. And we have Aramco looking to list its trading business, its energy trading business. And we have a whole host of privatizations. Everything from Emirates Airlines is being touted as a potential IPO candidate.
Yeah, and Sweta, so that's the role of the Middle East, and clearly that played a big role in that. Standard Chartered news of yesterday sent the share price up, more than 10% at one point, then came back down to up around 6 by the close. So the Middle East having a role there. The Middle East having a role then, as you point out, in the IPO market. What about the broader IPO story, though? Because in some Western markets, it has seemed quite moribund.
It really is, and the European story is a bit subdued for the moment. The Middle East accounted for something like 50% of EMEA IPO volumes on the whole, and bankers honestly aren't feeling too optimistic just yet about the European IPO market. There are a lot of headwinds here for investors. We have high inflation, high interest rates, a lot of reasons for them to really stay on the sidelines, and we don't have that big oil headwind, of course. There isn't sort of a positive catalyst here driving investors to the stock market, and we've had pretty poor returns from the 2021 crop of IPOs. So a lot of them are just sort of in wait and watch mode for now.
Sweta, when it comes to the environment for listings, does it matter more about the rate of change or the level of kind of interest rates and also what's happening in the market? So the fact that we had such a bad year last year, as long as we stay kind of flat in the equity market and flat in rates, will this be a much better year?
Yeah, hopefully. I mean, volatility, that's really sort of the key indicator of IPO activity. The VIX level is what most bankers look to sort of fuel issuance. And VIX has been incredibly high for much of 2022. But if that subdues, if markets become a bit more stable, if we see volatility ease a bit, then we could see a pickup in activity for sure.
Okay, Mark, thanks very much. Sweta, thank you very much. Sweta Gopinath joining Mark and I to talk about the capital markets outlook for the rest of the year. Coming up on the programme, we'll get back to some of the stocks in focus today, though. Stellantis is one of those. The automaker may shut more plants as the cost of electrification bites. We'll get the latest. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Welcome back to Bloomberg Markets Europe. But 10 minutes until the start of cash equities trading. European equity market futures point a little higher this morning. US equity market futures have been strong, but just coming off recent highs. Let us talk about technology. The CES 2023, that's the Consumer Electronics Show, wraps up in Las Vegas today. Bloomberg's Ed Ludlow has been at the conference, which has highlighted advancements in AI and in robotics, as well as the metaverse, gaming, and more.
So CES is back, kind of. There's 100,000 people here at the convention center in Las Vegas, and really the theme is about practicality and profit. In years past, it's been all about concepts and distant futuristic promises, largely surrounding automotive technology like robo-taxis and self-driving. Actually, what we see from the car makers in particular is they've kind of scaled that back. They've introduced ideas that are likely to come sooner rather than later. Take BMW, for example. Okay, it was weird. Arnold Schwarzenegger was on stage, and there was a futuristic car that could talk, and the windscreen isn't a windscreen, it's now a screen, largely driven by augmented reality. But bear with me, because BMW promised that the technology they showcased at CES will actually go into production vehicles by 2025. There's also an issue of practicality about the global economy. Take Samsung, for example. What they did was introduce a $200 handset, the Samsung A14 Galaxy 5G. $200 is far departure from the average handset price that we see, not just from Samsung, but Apple. And it's an acknowledgement that the global consumer, particularly when it comes to consumer electronics, is under pressure right now from inflation and basically a pullback in the global economy. What I'm hearing is actually there is a lot of caution about the global economy. They are taking meetings, but the idea that perhaps some M&A might take place or deals get proposed, or that investors will start a new funding round based on a conversation they've had here, there's a lot of cold water on that. The last thing that I had a conversation about on Thursday at the conference was Tesla. I spoke to Panasonic of North America and their CEO, and what she had to say was they're not worried about the demand concerns with Tesla. They're just focused on producing the volumes of battery cells that Tesla requires, and actually what they're seeing is more diversified demand when it comes to battery cells because new players are coming online. Those are all the themes that we talked about so far at CES Las Vegas 2023. This is Ed Ludlow for Bloomberg News in Las Vegas, Nevada.
Okay, all the themes there from Ed from CES 2023. Let's pivot back to Europe, though, but stick with the autos theme, actually. Tom McKenzie joins us, anchor of the European Market Open, to take us through some of the stocks that we're watching this morning. And I know that the auto sector will feature in our rundown today, Tom, but let's start with Shell.
Yeah, we'll get to the auto sector. Shell coming out with a trading update then, and importantly around the Q4 and the trading around gas, because it missed, at least compared to its competitors in the third quarter. They didn't perform as well despite those very high gas prices you saw last year. In the fourth quarter, though, they said that came in much stronger, significantly stronger in the fourth quarter around the gas trading part of the business. So we'll watch to see if that Shell gets a bit of a bump on the back of this. Of course, important year as you square up to what is happening across the commodity space, but it's on around trading on gas that was important, but also an update as well in terms of the tax hit, not just from the UK, that windfall tax on some of the big gas producers, but also European gas taxes as well, taxes on energy providers coming in at about $2 billion. So that's the update in terms of gas trading and that tax hit as well for Shell.
Tom, you're also looking at Stellantis. Now, I know Anna is getting very disappointed that EVs are still letting her down. So tell us the story there.
Well, that sounds like something we need to probe in a bit more detail. But just linking into what Ed Ludlow was saying around the focus at CES on the economic slowdown and the need to focus on the practicalities, we actually heard from the Stellantis CEO in Las Vegas saying, look, we may have to shutter more factories because of the costs of shifting to those prized electric vehicles. They've already idled a plant in Illinois, a Jeep making plant. Of course, this is the company that produces Citroën, Peugeot, Jeep, amongst others in its portfolio. And the CEO then warning of potential further shuts because of the impacts of those costs and the need to focus spending on electric vehicles. Also an update in terms of their conversations with their partners in China. They said those conversations are difficult. They want to reduce their footprint there because of the geopolitical risks. So that was an update for the CEO of Stellantis, Anna.
Yeah, okay, so to just clear it up for viewers, my skepticism was about, you know, cars might be able to operate with artificial intelligence and might be all about the touch screens. But at the moment, where I live in London, it's still very difficult to charge one. And if you can't go anywhere, then that might undermine their value slightly. Anyway, we'll leave my skepticism to one side and talk about chip stocks, Tom.
Yeah, important skepticism, Anna, though. So chip stocks, of course, you've been talking about the Samsung story. I know the profit drop, the biggest profit drop in about a decade, 70% in the most recent data, the most recent earnings for Samsung. One of its biggest customers, or at least clients, I should say, is ASML. We're looking more broadly, of course, at the tech stocks here in Europe on the back of that profit drop from Samsung as they face up to, again, a slower economy and reduced demand for electronics. So you can pick out ASML, of course, the lithography producing company around those big and significant machines, but also Infineon, STMicro as well. So whether or not be a read across from the market open when it comes to European chip makers and lithography machines.
Okay, we'll keep an eye on that. Many sectors in focus then. Tom Mackenzie, anchor of the European Market Open. He'll be back shortly with the start of European trading. Thanks to Mark for spending the past hour with us. The Open is up next. European equity market futures then do look slightly positive. US futures coming off earlier highs, though, on jobs day. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom Mackenzie.
And here are your top stories. Jobs, of course, in focus. Global stocks edge higher before today's closely watched US payrolls report as St. Louis Fed President James Bullard says rates may soon start bringing down inflation. First Abu Dhabi Bank confirms it did weigh a bid for Standard Chartered, but says it is no longer evaluating a possible offer. Shares of the London-based lender jump. Plus, the fight drags on. Kevin McCarthy fails in his 11th attempt to become House Speaker as allies struggle to reach a deal with dissidents to win their votes.
Now, Now, Tom, this is a look at the futures for the moment. They're pretty much flat. Of course, it's all about inflation, that U.S. jobs report in the U.S. So Eurozone inflation, U.S. jobs, and we're set for the weekend.
Yeah, just how tight is that U.S. jobs market, that U.S. labour market? The estimates are for around 202,000 jobs to be added with those non-farm payrolls out later today. And again, the Fed speak. Yes, we had James Bullard, not a voting member. Also Esther George, not a voting member, taking a slightly different line, saying that she sees 5% potentially holding through until 2024. Raphael Bostic also saying that there is a lot of work to be done still on inflation. In terms of the open then, the FTSE 100 currently gaining 0.3%, up 20 points. The Spanish IBEX currently range bound. We're going to focus on the yen as well when we go cross-asset, because that has been a central move within the currency space. Let's move it on and change the board. The losses, of course, across the equity markets of yesterday. NASDAQ down a little over 1.5%. S&P ending down more than 1%. The futures, though, pointing up just by 0.1% again as we lead up to the NFPs out of the US. And the yen under pressure, down 0.7% after reports of the Bank of Japan is and sees no need to make further changes, at least in the immediate future, around its yield curve policy. And that is pressuring the yen on the back of that. 134 on the Japanese currency. Brent trailing at $78 a barrel, just a gain there of 0.1%. And iron ore, I'm pulling this out for you because the linkages to the China story, the three red lines that now may be adjusted, a crucial policy, a central policy for addressing the real estate sector there in China. And the fact that policymakers are looking at adjusting that, easing that, is consequential. Iron ore currently getting almost 2%, and that is linking to the China story and the expectations there may be more demand for iron ore as that easing around real estate comes online. We are checking, of course, as well, a couple of individual corporates. Shell is central to us. They came out with a trading update around the gas trading business in the fourth quarter. You're seeing a gain of 1%, saying that they see a significant improvement in terms of the trading of gas within that part of the business in the fourth quarter. After the third quarter, they came in with a less rosy picture than some of their competitors, despite, of course, the increases in gas prices. Also an update in terms of the tax hit when it comes to European taxes and the windfall tax of the UK, about $2 billion US dollars. So currently gaining 1.2% on the back of that news over at Shell. Francie.
Now let's also get over to our Bloomberg MLife Managing Editor, Mark Cudmore. Mark, I know you're looking very intently of what the U.S. jobs numbers may tell us.
Yes, Fran, good morning. That is absolutely the big data print of the day. The story of 2021 into 2022 was a story of everyone, central bankers, economists, investors, being behind the curve on the inflation story. Well, the story of the last few months, 2022 into 2023, is the world being way too premature in looking for jobs market weakness in the US. There's still no sign of it. We saw that this week with ADB print, JOLTS print, and of course claims. There's no real weakness in the US jobs market yet. So we've got this really strange precedent in non-farm payrolls. For the last 8 months in a row, the headline print has come in above forecasts. So even though it keeps on beating forecasts, even though the jobs market keeps on being more resilient, we're determined it's going to fall soon. Is it going to beat forecasts for a 9th month in a row? Probably. My bet it is, and even Whisper on Bloomberg out of 162 forecasts put it at 240k above 202k official forecast. Everyone thinks it's going to beat. They're learning. Does that mean that the bar for a surprise is probably a little bit higher? Yes, indeed. But I think still we've got an asymmetric bias in going into today's data, that if we have a beat, and I agree the level for a beat is probably slightly higher than the official forecast, maybe 220k, 230k, then we'll see yields and dollar really rocket. Whereas if we come in roughly in line, they're probably not going to fall much further because they've already fallen a long way in the last couple of months. And the Fed is very clear they are going to keep fighting inflation.
Yeah, they certainly are. Thank you so much, our Mark Cudmore, our Bloomberg MLife Managing Editor, with the chart of the day, if not of the week. Now, we're also looking at why and how Standard Chartered is opening. Now, there's a lot of questions swirling around Standard Chartered, facing a lot of fresh questions of its future after we heard yesterday about that bid. Now, this is the first Abu Dhabi bank yesterday revealing it had looked at a bid for Standard Chartered, but then saying that they were no longer actually looking at it. So what really moved the price was the fact fact that they spent months exploring options, including a takeover. And I don't know whether it means that this is now officially a takeover target or whether we're going to see other banks trying to merge or buy it out.
Yeah, and to that point, Jefferies in the latest Bloomberg story on this, Jefferies analyst saying, and they have a buy rating on the shares, saying that it has awakened animal spirits in terms of the markets and their view on Standard Chartered. And I'm quoting from Jefferies, in any event, we believe that at least in the near term, Standard Chartered has an embedded M&A put, to your point, Francine. Let's bring in our guest and loop it back to the non-farm payrolls and that preview and the setup that we got there from Mark Cardmore. Our guest, Sonia Martin, Chief FX Strategist at DZ Bank. Sonia, good morning. Thank you for joining us. Is Mark Cardmore of our MLive team right in saying that the markets really need to wake up to the fact that there is no weakness in this US jobs market, that the resilience will continue?
Well, definitely that has been the case recently. We have seen, as Mark said, the numbers beat estimates consistently for some time now. But let's not forget, the US job market numbers are a lagging indicator. And even if the US still has a robust US labor market right now, that does not mean that the economy is not heading towards weakness. So we have to be a little bit careful here, not assuming that a strong job market necessarily means that the economy is immune to a slowdown. So that's something to keep in mind. But I do agree with him, if the numbers surprise on the upside, especially if it's a significant upside surprise, that is going to give the dollar a boost, and that should also see US yields rise.
Sonia, what does that do for dollar? Does it strengthen in 2023?
No, I don't actually think so. We had a really, really strong dollar in 2022, very much dominant currency in the market, driven obviously by a very aggressive Fed, driven by the expectation as well that the US economy would be fairly robust compared to other economies. So, and obviously also there is a safe haven argument. Looking into 23, I think that dynamic is going to change. The Fed is going to near the end of its rate hike cycle. There's very little room left now for the Fed to hike. So we're looking for 2 more rate hikes, and that's going to dampen dollar sentiment. And then also, I think, while there's still lots of risks this year, hopefully it won't be quite as bad as last year, so the dollar shouldn't have that much support anymore.
Sonia, what about support for the Japanese yen? Yes, it's rallied, about 6%, no, I should say 10% versus the US dollar since mid-October, but it's down for 4 straight days now, and we had the lines out of the BOJ. Was the call on stronger yen premature?
I have to say that the size of the move did take us by surprise as well. I mean, yes, the BOJ finally moved, and I think that the big surprise element, really, because no one had expected that to happen as early as, before the end of the year. So that obviously changed the dynamics significantly. But we are seeing some weakness creeping back in because there remains considerable uncertainty. I mean, all the BOJ did was widen the band. I mean, seems like a big step at the time, but ultimately it doesn't change the fundamental idea that the BOJ is still very much adhering to a very expansionary stance. We'll probably have to wait for Kuroda's successor in April to see what the BOJ will do. And so there's still a massive monetary policy uncertainty. So I think it was probably too early for this big move to happen and to be sustainable, yes.
Who do you think will be Kuroda's successor, Sonia? And this is, I mean, there was a huge move in the markets because they think actually, even if Kuroda can do this, and the successor is definitely going to find some kind of new agreement with the governor.
To be honest, at this point, we don't really know who's going to succeed him. The fact of the matter is that it seems unlikely that we'll see sort of a very dramatic monetary policy turnabout in Japan. But that doesn't really matter because I think as far as the market is concerned, even a slight movement away from the stance that the BOJ has been sticking to for such a long time is going to make a big difference. So, and that's already what we saw in December, of course. And if that were to be confirmed, that would make a difference. But, a total 360-degree turnaround is very unlikely to happen, I think, no matter who succeeds Kuroda, to be honest.
Sonia, I know you have an interesting call on the German Bund, and I wonder if you can link that to what your views are on the euro. But you expect a fairly significant continued sell-off in German sovereign debt, and you're forecasting, what, 3% on the German benchmark?
3%, yeah. It's funny though, because the 3%, I mean, it now seems suddenly quite an aggressive call when you look at the consensus forecast, but actually at the time that we made the call, it wasn't as aggressive as it has turned out to be. And that's because we have a dim view on inflation, basically, than the market. So the market is looking for inflation in the Eurozone to come back towards 2% in 2024. And that means that the market's probably playing with the idea that there'll be rate cut expectations priced in for the ECB. Now, we believe that the inflation rate is probably going to stay quite a bit higher. So our forecast for 24 is an inflation rate of 3.5%, and that's still very high. That's definitely high enough for the ECB to maintain a more restrictive interest rate level, and that means that bond yields are probably going to be higher, and that's really what differentiates our view from that the market currently has.
Sonia, one of our top stories, of course, is Standard Chartered facing some of these questions about its future, and it's undeniable that one of the factors that make it so attractive is also weakness in pound, which really attracts to already a cheap bank because of book value. Where do you expect sterling to go from here?
I mean, when I was asked by your editor about my views of the UK, I think all I wrote was, I don't even know where to start, because it really is such an incredibly dire situation right now. I mean, everything points to tremendous economic weakness. We have very high inflation, the cost of living crisis, there's the rail strikes. I mean, it really is not looking good. And I have to say, I mean, in fact, I think sterling has been surprisingly resilient given all of this. But the view on the UK does remain very negative. And I think maybe, especially towards the middle of the year, when we see other economies recovering from this very harsh winter, and it becomes clear the UK lags behind, that could put some fresh pressure on the currency, definitely.
All right, Sonia, thank you so much. Sonia Martin, their chief FX strategist at DZ Bank. Now, coming up, the Middle East's largest bank says it's no longer exploring a bid for Standard Chartered, so we'll have plenty more on that story next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
But 1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open, everyone. 13 minutes into the European trading day. And if you look at markets, they're kind of trading sideways. I mean, it's not a huge amount going on because it's all about the non-farm payrolls, jobs data in the US, and then we have a little bit also of CPI in Europe. So watch out for data points as we try and figure out what happens to monetary policy, well, this month and beyond.
Let's get back to a really important and one of the big bank stories of the week, arguably so far of the year, in fact. First, Abu Dhabi Bank says it is no longer exploring a bid for London-listed lender Standard Chartered. Bloomberg first reported the Middle East's largest bank had spent months exploring options, including a takeover. For the details, for more, let's bring in Bloomberg's Tom Metcalf, who runs our UK and Middle East finance coverage. How is the story being viewed in the city? What is the reaction to the fact that Standard Chartered's been eyed up by one of the big lenders in the Middle East?
Well, if you look at their shares, it's been a total roller coaster ride. So when our report came out, they rose something like a fifth. Then Fab came out very quickly and said, yes, we were exploring a bid, but no more. They kind of settled down about maybe 5-6% up, I think, now, given back a bit this morning. What's really interesting is how the city's reaction is, you know, even if this Fab bid doesn't materialise, all eyes are now on Standard Chartered, precisely because it is a pretty tempting target. As ever with bank and M&A, so many obstacles in the way, politics, regulation. But if you look at this market value, you look at kind of where it's positioned in the world, there is a lot of sort of interested parties out there, and I think you'll probably see a lot more news coming on in this space.
So why is it attractive? I mean, first of all, it's relatively small, I guess, 24 billion in terms of market cap. But also, I mean, how much does it have to do with weakness in pound?
Well, there's the weakness in the pound. Yeah, it's valued at something like 0.65 of its book value, so really, really low. And, you know, for me, it's been watching Standard Chartered for a while, 24 billion. I'm like, wow, that seems like a pretty good deal. And then, of course, it's positioned in, right? It's an emerging market lender, so it's in those markets. There are a lot of banks, you know, in the West are maybe trying to get in. And obviously for Fab, you can see why it would have been appealing for them, because in a stroke, they become, you know, by far the biggest bank in the region.
Okay, and they can't make, at least on the top line, they can't make another offer for 6 months or so. What does this tell us about the banking sector more broadly?
I think it shows that there is a lot of attractive sort of assets out there. That was one of the big things among analysts going, hey, look, this is not just a Standard Chartered story. This is a good reminder. There is a lot of franchises out there that are basically, when you know, run the metrics, looking a bit undervalued.
So do we think that actually First Abu Dhabi Bank would also go after someone else? Or do you think that others will come in and buy Standard Chartered?
I think, well, I think there's just going to be a lot of sort of M&A chatter. I think, you know...
There's appetite out.
Exactly. And I think whether that ever comes to pass, who knows, maybe little bits and bobs of banks or fintechs will get acquired. But I certainly think I'll be on quite a lot talking about M&A this year.
There you go. Tom Metcalf thought he had an easy start to 2023, and he's right on the M&A beat, Bloomberg's Tom Metcalf. Now, we also have to look at oil. Shell says its gas trading earnings were significantly higher in the final 3 months of 2022, despite some setbacks in its LNG operations. The update published today suggests that the company was able to overcome the challenges faced by its trading division in the third quarter. Well, joining us now is Will Kennedy. He's Bloomberg's Senior Executive Editor for Energy and Commodities. Will, commodities are up, they're down, profits are up and down. What's the next 6 months going to look like?
Well, Shell, I think, shows you how volatile earnings from their trading businesses can be, and sometimes how they don't follow the ups and downs on prices. So they had a very strong trading quarter in the last quarter. That's what the trading update said today, and that was in contrast to the previous quarter, where their traders hadn't done so well and BP's traders had done very well. So these trading results often rely on the skill of trading desks and the calls they make rather than the direction of the markets. And they had a good quarter, as you say, offsetting some lower production from an outage in Australia. Obviously, the start of this year has been dominated by lower natural gas prices in Europe. We've seen some weakness in oil price. That will clearly feed into earnings as we go into 2023. We saw Exxon saying that lower gas prices in the United States, where they've also come off, will be a headwind for them. So that's the background as we start the year.
Will, what is the consensus? We're looking at Brent at what, $78 a barrel, WTI at $73 a barrel. Is there a consensus forming as to the price direction over the next 6 months, and whether or not indeed OPEC Plus is going to have to step in with further cuts?
Always reluctant to make a price call, and of course a lot will depend on the broader macro picture, how bad, how deep, how shallow any recession is. However, I think there are a lot of analysts out there looking at today's price who are feeling slightly bullish. We've got COVID reopening in China, and while that's created some turbulence in the short term as the wave sweeps through the bigger cities, I think there's a consensus that will add significantly to demand as we go through the year. Supply growth remains a challenge. Shale underperformed in 2022. People don't expect any lightning growth this year. Big oil companies aren't investing at the pace they need to grow their own production. So when you look at the balances, things look like, if the economy stays fairly healthy, that things could get tighter over the year. So when you think about the balances in even direction, I think a lot of analysts are probably looking a bit more bullish and bearish.
I think you should make a price predictions. 2023, let's just all be bolder. Let's go for it. We can do it on Twitter. That's a good Twitter poll. There you go. Elon Musk, that is the Twitter poll that you're going to do next. When you look at, some of the dynamics, your OPEC Plus, it's January, you have to balance the books, you're thinking of how much money you have in your treasuries. You look at the price of oil, and what do you think?
You're not going to let you're not going to let me off, are you? I think we will end the year somewhere between $70 and $110. That's not seen.
I think between 60 and 150.
Wide margins, there you go. Safety in the wide margins. Will Kennedy, I think we have a very, about 30 seconds left. In terms of the tax windfall, that was something else that Shell updated on. Any surprises there? $2 billion.
Yeah, it's quite a punchy number, and I think it shows you that these taxes between Europe and the UK are fairly material. I think that there will be some feeling in the industry that the worst might be behind them. Obviously, one of the impacts of lower gas prices in Europe is that the bill that governments in the UK and the EU have to find to help compensate households and businesses for higher energy prices is falling away. So some of the fiscal pressure to raise revenue from these very high oil and gas profits may fall away. And of course, if prices do continue to fall, and we're not bullish on the oil price, then profits will fall with them and there'll be less windfall to tax. So I do think that perhaps some of the heat has gone out of the windfall tax debate, and that might be somewhat of a high watermark.
Really interesting. Will Kennedy leading our energy team, of course, with that very, very bold prediction on prices for oil of between $70 and $110, just a $40 margin. Thank you, Will. Shell currently trading up 0.9%. Coming up, more political chaos. Yes, US Republican Kevin McCarthy blocked for just the 11th time in his bid to become Speaker of the House of Representatives. That story next, with the implications and the analysis. Stay with us. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
until markets stop being on a 45-degree angle to the downside, the price action is the Bible. I mean, we're in a major bear market. I think investors fail to really see the forest through the trees in that all asset prices continue to go down. Stocks, bonds, cryptocurrencies, SPACs, whatever you might want to point to.
Well, that was Eagle View's capital management founder, Neil Berger, giving his market views, and his contrarian macro fund soared around 163% last year, betting on the market downturn in its first full year. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. China is planning to relax restrictions on developer borrowing, dialing back the stringent so-called 3 red lines policy that's exacerbated one of the biggest real estate meltdowns in the country's history. Bloomberg understands Beijing may allow some property firms to add more leverage, as well as pushing back the grace period for meeting debt targets. The easing could mark the most dramatic shift in China's real estate policy to date. U.S. authorities are ratcheting up pressure on Sam Bankman-Fried's inner circle. That's as Bloomberg has learned former close FTX associate Nishad Singh is being probed. The scrutiny of Singh, who until recently lived with Bankman-Fried in a Bahamas penthouse, presents the latest legal threat to the FTX founder. Singh has not been accused of wrongdoing. His lawyer declined to comment. Citadel Securities raked in a record $7.5 billion in 2022, capitalizing on last year's volatility and raising its presence as one of the largest trading units in the United States. Revenue for the market-making arm of Ken Griffin's Citadel empire jumped 7.1% from the previous year. Citadel Securities says it's now posted 12 consecutive quarters of net trading revenue in excess of $1 billion. That's the Bloomberg Business Flash. Tom, Francine.
Laura Wright here in London. Thank you very much indeed. Let's quickly get you up to speed with some of the individual corporates that are moving, some of the stocks that are on the move this morning. We're going to start with what's happening with Shell. We had that trading update. Will Gedev gave us the context and the analysis around this story. Currently gaining 1.4% after they said that fourth quarter trading around gas came in significantly higher than the third quarter. Standard Chartered, that is another intriguing story. Of course, we're breaking out with Tom Metcalf around that potential offer or takeover target, of course, the London-listed bank by First Abu Dhabi Bank. They say they are now no longer looking at the bank, but analysts saying there is potentially a price in this stock around being an M&A target. ASML, this is linked to the Samsung story. Profits dropping by a record 70% for Samsung, which is a major client for ASML. Currently, ASML down 0.4%. And we're going to have more on the Samsung story, and we're going to dig into US politics in the next half. Stay with us. This is Bloomberg.
Fascinating entrepreneurs, because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by by making, you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, I mean, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, you know, proximity is going to be key.
DOJ or other authorities
could face bigger challenges.
Britain's next.
was going to keep rain World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make this decision. Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Jobs in focus. Global stocks edge higher before today's closely watched U.S. payrolls report. At St. Louis, Fed President James Bullard says rates may soon start bringing down inflation. First Abu Dhabi Bank confirms it weighed a bid for Standard Chartered, but says it's no longer evaluating a possible offer, where shares of the London-based lender jumped. Plus, the fight drags on. Kevin McCarthy fails in his 11th attempt to become House Speaker as allies struggle to reach a deal with dissidents to win their votes. Actually, I think there's a bit of volatility for Standard Chartered. They were up, they were down, and I believe now they're still down.
Yeah, and the markets overall are kind of treading water ahead of this non-farm payrolls number. We did, of course, have a couple of Fed speakers coming out, the likes of Bostic and Esther George, suggesting that the fight around inflation, some ways to go. According to Bostic, Esther George saying, look, you could be seeing 5% and holding above that level into 2024. James Bullard, though, on the other hand, saying that maybe we're closing in on a rate that is actually going to have a material impact on pulling inflation lower. Across the benchmark here in Europe, you're seeing losses, or gains, I should say, of just 0.1%. Futures also in the US pointing higher. The DAX, as you can see, is down, but the FTSE 100 gaining on the back of what we're seeing in basic resources, iron ore, and the links then to the news reporting out of China that they are considering further significant measures to ease around the property sector. The FTSE 100 gaining on the back of that, up 0.4%. Let's switch it over and see how things are playing out then across those sectors. And yes, basic resources is near the top of the list, getting 0.9%. Energy also gaining up 1.3%. I'm just looking at Brent and WTI. Brent at $78 a barrel, just a gain of 0.1%. WTI, $73 a barrel, also up 0.2%. At the bottom of the list when it comes to your sectors, autos taking a hit, down 1%. Let's check in your sectors this Friday morning, 8:31 here in the City of London.
Now let's talk tech and chips. Samsung's profit has dropped the most in more than a decade. The tech giant has actually been hit by weak demand for chips, smartphones, and displays. Now, for more on all of this, we're joined by Bloomberg Quick Takes Alex Webb, who focuses and specializes, I think he's team leader actually, for all tech coverage. Alex, when you look at what we heard from Samsung, are people switching to other providers or other hardware, or is this going to be an industry-wide problem?
It certainly looks like an industry-wide problem, which also is why Samsung is having particular problems, because it has sort of double exposure. On the one hand, it makes the electronics, it makes, you know, smartphones, displays, as you said. They did pretty well during the pandemic. There was a lot of spending on electronics. As people's purse strings have become increasingly tight and they've stopped buying those. So Samsung's not only making the chips that go into their own products, but also into those of their competitors. And so it gets a double whammy that as the consumer electronics business slows down a bit, they struggle. Now, the one thing they're slightly different from their competition, they're continuing to invest in capacity for the semiconductors. Now, that's increasingly looking like a bit of a problem because it means there is oversupply, and that is being detrimental to prices of these chips. Ironically, despite all of this bad news, 69% drop in operating profit, the stock is actually up today. That's partly because of a Bloomberg scoop, which is that Kioxia and Western Digital, two big competitors in the memory chip market, are discussing a merger. The benefit of that would be there'd be consolidation in the space. That means you get better pricing. Nonetheless, there's a lot of speculation right now that Samsung will need to tamp down on its chip capacity.
All right, quite a shift from just 12 months ago. Alex Webb, thank you very much indeed on the fortunes of Samsung and the broader electronics space, of course, from our Quick Take team. Let's stay on the tech space, though, and shift focus to what is happening in China. Tencent, one example, back in the club of the world's 10 most valuable companies. What a turnaround for that company as well. For the first time in 6 months, reflecting broader optimism, investor optimism for Chinese equities. And it comes, of course, as Beijing dismantles that stringent COVID-0 policy and refocuses on growth. And of course, there have been measures as well to ease around the tech sector. Let's bring in then Ben Harburg, managing partner at MSA Capital. It's a global investment firm which manages $2 billion in assets, including significant holdings in China. They've invested in the likes of Uber as well, Airbnb, and in China, the likes of Meituan as well, and Neo. Ben, good morning. Thanks for coming to the studio. Really great to have you on. You spend a lot of time, of course, on the ground in China. As we look at the changes, and you're seeing approvals for gamings, for example, and you're seeing the approval of the capital raise for Ant of around $1.5 billion, how significant are these changes? Is this a material pivot now in terms of China's crackdown on technology? How convinced are you and your LPs that this marks a pivot?
Well, there's a difference between me and global investors, but certainly for those of us on the ground, this is a massive shift and one that was anticipated. We saw this coming on the basis that once we had the Central Party Congress in October, that would provide kind of political stability. Then we had the Central Party Work Conference that laid the groundwork for the type of growth that they'd be stimulating this year, a much fresher and positive attitude towards entrepreneurs, towards the technology platform companies like Ant and its parent Alibaba, Tencent, and obviously a lifting in a lot of the regulatory sanctions that were imposed on technology businesses.
Ben, you're confident with that call, because it seems that with the sudden reopening and I guess abandonment quite aggressively of COVID-0, there's a lot of questions on what the focus on. Yes, life sciences, technologies is still a question mark of what they plan to do longer term.
Certainly, I think there's a focus on life sciences and core technology, particularly as we have to wean ourselves off dependence on the United States. We're seeing a first-in-class emergence of newly innovative technologies in the life sciences space, the likes of which we'd never seen before in China. But I do think this is a very authentic effort from the Chinese government and will continue throughout the course of the year. It has to. Last year was just simply devastating on the economy.
So it's authentic. And our LPs, because you had a nod to this in your answer then, that there's maybe a different, in terms of your view and the view of LPs, are you struggling to convince LPs, your US-based LPs, that they should now get exposure, or they should continue, or they should increase their exposure to China?
There are different classes of limited partners around the world. So there are those in underexposed markets to China, like those in the Middle East. They are very convinced of the opportunity there. I think people in Europe and other relatively underexposed markets are now warming up to the idea. And I do think that China is probably a better bet today from today's levels relative to the U.S. To see improvement over the course of 2023. Other markets like the United States might be to some degree over-allocated to China. And also there are some political and moral concerns there that might outweigh some of the financial considerations around recovery. And so there's a bit more pushback from some of those limited partners.
So, Ben, concretely, where do you want to invest? And actually, are you seeing really the U.S. and China getting closer, or is that going to be a very volatile relationship this year?
2023 definitively will continue to accelerate that decoupling. I expect that potentially in the next couple months, if not weeks, we'll see some form of a capital ban from the United States towards China. We've already seen actions taken in the chip space. Definitively, the United States is working to quell the rise of China as an economic and political counterweight, and I think that will accelerate in this year.
Okay, you're pretty definitive on that then. So how do you, if you do want that exposure to China, how do you shelter yourself from that volatility and those adjustments that you expect?
Well, the key thing first is to listen closely to the ground and put yourself within the regulatory slipstream of the Chinese regulators. And that's these sectors like core technology and life sciences, which definitively need to grow. Some of the bigger technology platforms, particularly on the consumer side, continue to see some of the regulatory interventions we saw. I don't think we're out of the woods yet there. So clearly you need to be where the government sees growth needing to come from and the critical needs sectors. And for us, those are those spaces in energy, new energy, efficiency drivers on the enterprise side, of course, core technology, and then this first-in-class emergence in the life sciences space.
Yeah, how difficult is it, Ben, to go in? I mean, you definitely need some, I guess, partner locally to make sure that you're protected somehow, or how do you do the investments?
We obviously have a large team on the ground. We have about 40 people on the ground in China, and this is a country that has definitively you have to be there on the ground presence. If you are operating from other markets, it's extremely challenging. The last 3 years saw this massive arbitrage between what Western investors understood about the market and the realities on the ground, because very few China watchers, be they political or economic, were actually on the ground physically in China. And that just accelerated a lot of these false narratives around the market that I think misled global investors.
Just broadly, Ben, and you spend a lot of time with Chinese entrepreneurs. What has this done to China's entrepreneurial capacity, entrepreneurial drive?
2022 was a very challenging year. It was just one hit after another, a perfect storm of factors, and we saw a mass exodus, actually, of affluent and entrepreneurs leaving for markets like Southeast Asia, coming here to London and elsewhere. It was challenging, but I think if you look at the market outlook today relative to other markets, there does seem to be more opportunity for growth. We have a lot more bullets we can fire to stimulate growth. We have a lot more deltas where we lag the West in terms of healthcare, core technology, and also we have a lot of human-enabled actions that can take place to stimulate growth. So rolling back zero COVID, now this lightening of the risk of delisting of Chinese companies on Western markets, and of course now this regulatory intervention. So all of that provides a really robust environment for entrepreneurs to again work and grow.
All right, Ben, thank you so much for coming on. Ben Harburg, their managing partner at MSA Capital. Coming up, more political chaos. U.S. Republican Kevin McCarthy blocked for the 11th time in his bid to become Speaker of the House of Representatives. We'll have plenty more of that next, and this is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together. Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open. We are 42, almost 43 minutes into the European trading day. Range bounds flat across European equities as we lead up to that important job sprint out of the US non-farm payrolls. The economists, the surveys expect around 202,000 additional jobs. And we had the jobs data around ADPs out earlier this week, just pointing again to the resilience in that jobs market, what it means for the Fed and their ability or their desire to further tighten. Futures in the US, S&P E-mini is just up 0.1%, NASDAQ futures flat as well. Francine.
Now, U.S. Republican lawmaker Kevin McCarthy has been blocked for the 11th time in his bid to become Speaker of the House of Representatives. Now, the group of 20 GOP hardliners have yet to agree on a deal that satisfies their demands. Well, joining us now is Julie Norman, Associate Professor of Politics and International Relations at UCL. Julie, thank you so much for coming in. I mean, what the heck is going on? When you look at, I mean, it's difficult actually sitting from the outside, and I know we've spoken also to a number of these hardliners, GOP, to see a way forward at this point. Do you see a way to get through this?
Yeah, well, it's certainly going to be a long road ahead, I think, Francine. You know, what we see now is going into the 12th round of voting today. This is something that we haven't seen since before the Civil War. Normally, this process is pretty straightforward. Usually, it's resolved in the first round, maybe with some backroom deals or some concessions, but it usually moves forward pretty quickly. What we do see now is I have heard over the last night that McCarthy is still trying to make some further concessions to this group of 20, maybe trying to get a few votes to change today. Still probably not enough to get him over the threshold, but maybe enough to build some momentum and start getting some others to turn onto his side. But the alternatives are really not viable alternatives for most Republicans, such as like leading up behind a moderate.
Yeah,
so.
and let's go there, but let's start with the concessions then, because that leaves him pretty vulnerable if he does finally get through and across the bar. Those concessions hand the agenda arguably to the extremists within the Republican Party, and he'll be held to account by them. How vulnerable would he be left as a result of that?
That's it, Tom. I mean, McCarthy is setting himself up to be extremely vulnerable. One of the concessions that's understood to have been made is to allow for even one single member to call for a vote to oust the Speaker. So that makes him, or anyone who takes over that space, very vulnerable, because even if McCarthy steps aside, whoever comes into that next round of voting would probably have to stick to that same concession. So it really does make whoever's there quite beholden to this group, as we expected, but probably not to this level.
So, Julie, does this change everything, actually, within the Republican Party, but also U.S. politics?
Well, I would say some of this was somewhat expected. You know, we knew that with this very slim majority that the Republicans were coming into the House with, that they would be beholden to some degree, to the Freedom Caucus, to some from the MAGA movement, what have you. But I don't think anyone expected them to wield this leverage quite so heavily, quite so soon. But it was something that was somewhat expected. This kind of infighting is, again, not new, but I think we're seeing it highlighted in a different kind of way right now.
Is this good news for the Democrats, or should they be worried about these Republicans staring down the debt ceiling?
I'd say a bit of both. I mean, right now, I think Democrats are, quite literally getting out the popcorn and watching this kind of play out. But in seriousness, they are, I think, quite rightly worried about some of the governance ahead for the next 2 years. The fact that, if this group is doing this with their own speaker, what will they do with the debt ceiling? What will they do with the budget? Pretty much no holds barred.
And Julie, what does this mean for 2024? So is it almost, or is it more likely that there's a more right-wing Republican candidate, either, Donald Trump or someone else?
Well, it's certainly quite possible. What's interesting is that Trump has had very little sway over this group. He's encouraged them to line up behind McCarthy, and they simply haven't. But what we do know, too, is one of the concessions that this group is pushing for is McCarthy to not promote moderate candidates over the more extremist ones. So that could set up a bit more of a hard right Republican band for 2024.
Yeah, and what's fascinating is that this is being led, this agenda, of course, by this very right-wing group, and arguably the right-wing politics that they espouse was rejected at the ballot box in the midterm. So big questions there for the Republican Party. Should the Democrats ride to the rescue for McCarthy? They could line up and give him the votes that he needs.
They certainly could, and I think one thing that's important to underscore here is it's not simple ideological lines. I mean, McCarthy himself has been very loyal to Trump. One of his toughest allies is Jim Jordan. So we're not talking about a group of moderates here who Democrats are looking to align behind. And right now, it's still in their interest to stay united behind Jeffries, show where their unity is, and let Republicans still figure this out.
I mean, does it, Julie, bring everyone more to the right, even the Democrats, as then they maybe in 2024 play for that centrist vote?
Well, what I think it does allow Democrats to do is to be in that moderate space a little bit more, and no one more than Joe Biden. I mean, we saw this week, the first day that the ballots were going into this, Biden was in Kentucky with Mitch McConnell in kind of a joint infrastructure unveiling. So I think it allows Biden to show that he can get deals done, he can be bipartisan, and be in that moderate space a little bit more than he's been in the past.
Okay, Julie Norman, really, really fascinating context for the voting that continues and the impasse, at least for now, around McCarthy as potential head of the House for the Republicans. Associate Professor Julie Norman there of Politics and International Relations at UCL. Thank you. Let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. Ukraine has dismissed as a ploy Russian President Vladimir Putin's call for a 36-hour ceasefire for Orthodox Christmas. The US and Germany, meanwhile, will send armored vehicles and an additional Patriot air defense system to Ukraine, a significant upgrade in firepower sought by President Zelensky. US authorities are ratcheting up pressure on Sam Bankman-Fried's inner circle. That's as Bloomberg has learned former close FTX associate Nishad Singh is being probed. The scrutiny of Singh, who until recently lived with Bankman-Fried in a Bahamas penthouse, presents the latest legal threat to the FTX founder. Singh has not been accused of wrongdoing, and his lawyer declined to comment. The UK Nurses Union wants the government to meet it halfway on pay, a sign of softening positions ahead of more planned strikes later this month. The General Secretary of the Royal College of Nursing told Times Radio she wanted the Health Secretary to move much closer to the 19% pay rise sought by her members. So far, the government has offered an average increase of around 4%. This week, UK rail workers have also been on strike. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom Francine.
Laura, thanks so much. Laura Wright in London. Now, coming up, we'll have, of course, plenty more in Beijing, planning a major shift in policy aimed at boosting China's troubled real estate sector. We'll have all of the details next, and this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open, everyone. 52 minutes into the European trading day. It's a boring day. Not for long. We're expecting that jobs number from the U.S., but for the moment, they're trading sideways, and then we're talking about some of the movers. Standard Chartered, keep that in mind. But you can see some of these European equities pretty much flat, Tom.
Yeah, another big adjustment, at least being considered in China. Bloomberg has learned that China is planning to relax restrictions on developer borrowing, dialing back what was being described and what was framed as the 3 red lines policy that exacerbated one of the biggest real estate meltdowns in the country's history and therefore in world history, arguably. Joining us now from Beijing is John Liu, Bloomberg's managing editor for Greater China. So the significance of this, just outline for those of us who are not in the weeds on this policy, how important this potential shift is, John.
I think this is the clearest signal yet that we've gotten that the tune has changed here in Beijing. You'll remember these 3 red lines started leaking out in late 2020. They put thresholds on developers in terms of net debt, in terms of cash to short-term borrowing, in terms of liabilities to assets. And if developers don't meet those thresholds, they're not allowed to borrow. And that precipitated this big drop-off in the ability of those developers to finance their construction. It's probably the main reason we've seen Evergrande sort of collapse the way it has, the troubles that developers like Sunak have come under. And now it looks like the government is softening their stance, saying that they might thinking about easing off on some of these restrictions, looking at potentially pushing back the date by which developers have to meet this. It was June, end of June this year. It might get pushed back to the end of 2023.
So, John, what does it actually say about Beijing's shifting approach to the economy? As again, we're trying to figure out exactly what the priorities will and won't be in 2023.
I think it's very clear that 2023 is going to be all about growth, Francine. Everything that we've seen happen in the last month or so has pointed in that direction, be it the exit from COVID-0, supporting property developers. Everything is about getting this economy back on its feet, people back in their jobs, factories humming again, and making sure people are happy.
Yes, it's fascinating. And then geopolitics as well, arguably slightly softer tone when it comes to the US and Australia with that announcement, or at least that consideration around coal. John, what else are you and the team looking for then if this is the year when policymakers in Beijing double down on growth?
I think the big thing looking forward will be the National People's Congress in March. It'll start March the 5th. The main event of that day will be the premier giving an economic target for the year. If it's somewhere in the 5% range, I think that will just underline how much of a priority getting GDP growth up again is going to be for this government, and the preparedness of the government to sacrifice on other things, allowing more debt, having better relations with other countries, rolling back some of the COVID restrictions. All of these things are going to fall by the wayside if they can help growth get back to where the government would like to see it.
All right, John, thanks so much. John Liu there, Bloomberg's managing editor for Greater China. Now, Tom, we have quite a lot of movers on the move. I don't know whether that's the right way of putting it, but certainly, Shalin, we're also looking at Standard Chartered.
Yeah, it's definitely more interesting than the top line, the broad benchmark, as you say, currently essentially unchanged. Well, in modest gains of 0.1% across Europe, but it's the individual stories that are more interesting. Shell, we know, came out with a trading update around the gas trading part of the business, more positive, significantly better than third quarter, gains there of 1.4%. ASML, that is a linkage to the Samsung story and the drop there of about 70% in terms of the latest quarter on profits. ASML is a major supplier to Samsung, so taking a bit of a hit on that, down 0.8%. Standard Chartered, of course, is the standout financial sector story of the week. A hit there of 2.6% after Bloomberg reported on a potential takeover from First Abu Dhabi Bank. They came out and said, we are no longer looking at Stand Chart. So a drop there after a rally in the stock. Plenty more coming up. Surveillance Early Edition is next. This is Bloomberg.
There's more activity in the fusion world than ever, and
and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This
is Countdown to the Close. Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Jobs in focus. Global stocks and futures edge higher ahead of the the key U.S. payrolls report. I'm all muddled up. St. Louis Fed President James Bullard says rates may soon start bringing down inflation. First, Abu Dhabi Bank confirms it weighed a bid for Standard Chartered, but says it's no longer evaluating a possible offer, while shares of the London-based lender is sliding after an initial jump. Plus, the fight drags on while Kevin McCarthy fails in his 11th attempt to become House Speaker. Allies struggle to reach a deal with dissidents to win their votes. Now, let's check in on the markets. For the moment, we're kind of seeing plain sailing ahead, or certainly nothing huge to write home about. If you look at European stocks, they're pretty much flat. S&P futures gaining some 0.1%. The focus firmly on that jobs report. That could change, of course, expectations for monetary policy and what the Fed does. Let's get straight on to, we did have a great briefing, actually, from Will Kennedy on what WTI could do this year after we had that Shell report. But let's also get down to the individual industries in the individual countries. So you can see the FTSE gaining 0.2%, the DAX over in Germany pretty much flat. So markets in a positive mood ahead of the latest jobs figures out of the U.S. later today. Now, investors are on watch for the data, which will, of course, help chart the path forward for central bank monetary tightening. Now, joining us now is Richard Saldana, portfolio manager for global equities at Aviva Investors, and Lynn Thomason, Bloomberg Markets editor. So thank you both for joining us. Richard, good morning. Let me start with you. What's your biggest concern for 2023?
Well, good morning, Francine. I mean, I think there's still a lot out there to be concerned about. I mean, certainly when we think about, the fight against inflation, the comments that we've seen from the Fed this week certainly suggest that, restrictive policy is going to remain in place. So, I mean, that's acted like as a pretty big break. We think about last year, that big move we've had in the 10-year yield, what that's meant in terms of valuation, particularly for some of the growth stocks out there. And we've seen the impact that's had on the NASDAQ and tech companies in particular. So in our view, that's still, I think, front and center in many ways for investors right now.
Lynn, thank you, Richard. I mean, Lynn, when you look at all of these, things that Richard kind of put on the spotlight, but also the jobs data today, is there a risk that markets still misunderstand, and we hear it almost every day from Fed speakers, misunderstand how aggressive the Fed will be, or at least that, these interest rates going higher can stay there for a lot longer than we think?
Yeah, absolutely. I think, the consistent theme in the market is everyone is looking for that pivot. When is going to be the pivot? When is going to be the pivot? But the Fed is continuing to say, we're in this for the long haul, and we're going to tamp down on inflation. And I think, the mood from investors is the risk that this all, sends us into a global recession.
Richard, do you think we're looking at a global recession that could still be avoidable, or actually is it almost a done deal?
No, I don't think it's a done deal necessarily. I mean, look, we've certainly seen, economic growth is becoming more challenged out there, and clearly the tightening we've seen from central banks has also led to that. But if you're looking for sort of signs of optimism, certainly we're starting to see some signs inflation may be peaking. Obviously, we'll get the Eurozone numbers today. And if we start thinking about the sort of glide path, if you like, for the Fed, look, we're certainly a lot closer to terminal rates than we were sitting here this time last year. So whilst we don't expect any major pivot from the Fed, we do think if you start to see signs of that we're getting close to that terminal rate, or a peak, if you like, in interest rates, then we think actually that will also be beneficial for equity markets. I think there's also other aspects as well. Obviously, the recent easing of COVID restrictions in China, I think, is certainly helping sentiment. We've seen that in terms of some of the moves we've seen in the Chinese equity market this year so far. So I think there are it's not all doom and gloom, certainly as far as we're concerned. I think there are some some light, some signs of light at the end of the tunnel as well.
Okay, some signs of life. And then, as you were saying, in 2023, a lot of, smart money is trying to figure out whether there's definitely a recession coming or not. Where do you see the money moving to?
It certainly seems that the overall trend is moving money away from the U.S. and into Europe and Asia. At least that's what we're seeing this week. Like Richard said, the first signs of softening inflation have sparked this remarkable rally across Europe this week. And whether it will hold will be the big question for the year ahead. But certainly it seems that people are willing to buy into the possibility that perhaps the European story is better than they expected and put money to work.
Yeah, do you agree with that, Richard? And if you look at Europe, are there pockets actually where valuations are just so cheap, and maybe the ECB does something different to the Fed where you could see value?
Yeah, I think so. I mean, when you think about last year and the market, I mean, the US was almost a safe haven, right? When you look at, how investors were allocating, right? And, particularly China was, I'd say, shunned in many ways by investors. And that worked out pretty well last year. But as I said, now you're starting to see that, the restrictions easing, certainly a pent-up consumer there. So I think that has implications for a few sectors. And then in Europe, I think obviously, over the Christmas period, people have probably been shopping for bargains. And if you look at valuations in Europe, we'd argue there's probably, reasons for bargain hunting there as well right now. There's some great companies in Europe that we think are pretty undervalued right now. So I think there's lots of reasons why investors should start looking outside of the US and to the likes of Europe and Asia, where valuations, frankly, are a lot more appealing.
So, Lynn, will that also spur a lot of M&A? I mean, we had this, pretty incredible story yesterday that Bloomberg broke first about Standard Chartered. I mean, part of it is book to value. Of course, it's pretty cheap. If you look at market cap, it's cheap. And then there's that added, I guess, bonus if you're a buyer of weak sterling.
Yeah, it's interesting because also then you've got the conflicting story of, well, if we're in a recession, interest rates are rising, are you really going to see a lot of M&A? And I think, it's an absolutely good question that, I can't say I have a good answer to, simply because, if you start to see this slowdown, which, the old adage is when the U.S. catches a cold, the rest of the world is really going to be in trouble. So, I think you've got these two competing narratives in the market, and which one actually wins out will be the story to tell.
And so, Richard, do you see more decoupling between China and the U.S., and how do you play China at this, I would say, difficult juncture for the country?
Yeah, no, you're right. It is difficult. And look, whilst we've had, positive news, certainly in terms of easing of those restrictions, I think it's quite clear the path to reopening is going to remain quite uneven, right? We've seen that in terms of the step up in cases there. But look, I think, ways to play that, when we think about Europe, and looking at valuations, we think some of the luxury goods companies there, so the likes of Kering, Richemont, LVMH, we think that's a great way of playing that sort of China reopen story. Pent-up demand, as I said, for consumers to go out, and shop again, go into retail stores, buying luxury goods. We think that dynamic is, we think this year actually could work quite well. So that's certainly one area we'd be looking at. Even some of the semiconductor companies, again, which have sort of, manufacturing footprint there, we think could benefit from a sort of China reopening story as well. So I think there's quite a few ways of playing it, but I think you can play that as well through some of the companies in Europe as well.
Okay, brilliant. Thank you both for joining us. Richard Saldana, Portfolio Manager for Global Equity at Aviva Investors, and Lynn Thomason, a Bloomberg Markets Editor. Now, coming up, if at first you don't succeed, try again and again. Kevin McCarthy loses a historic 11th round of balloting to become Speaker of the House. More on that next. and this is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Kevin McCarthy's bid to become Speaker of the House has been blocked for the 11th time. It's caused business to come grinding to a halt, despite McCarthy offering significant concessions to win more votes. Now, for more, we're joined by Bloomberg's Stuart Wallace. Stuart, thank you so much for coming in. This is an amazing story, and you kind of wonder whether he's then going to do too many concessions or actually whether he just can't get this through. So, are we seeing any progress?
No, not much. But just, I need to remind everyone, this is the world's largest economy, one of the most important democracies on the planet, and you have a party with a majority that's incapable of electing a speaker, which means no one gets sworn in, no legislation gets formulated, nothing gets done. That is the level of dysfunction we have. And in terms of, specifically to answer your question, no, it doesn't appear to be. We are now on day 4. We've had 11 ballots. Okay, we're a ways off the record, which I think is 133, something like that.
133 votes. Let's just think about that.
But that happened before the Civil War. So again, the context, different era. And again, I think in terms of what we need to think about, yes, it is hugely important for US domestic policy. Yes. Of course it is. But more widely than that, we are now in an environment where economies are weakening. We've got a massive land war going on in Europe. We've got global trade fracturing. We've got a complete redrawing of the global map. And in that scenario, the last thing you need is the most powerful nation on the planet in sclerosis. And that is effectively what we see here.
But so if the two sides reach a deal, is he definitely the House Speaker? But then there's also so many questions about the debt ceiling and actually economically, if you have 20 GOP hardliners that will just vote no for people within their party, then it's going to be difficult.
Yeah, basically, I think it's going to be impossible. If anything, I think you're being too generous with difficult. As things stand right now, the concession that concerns me the most is we get to a point where one single member can institute a motion to dethrone the Speaker. If you're in that environment where one individual can basically derail everything, then nothing's going to work. And as you say, debt ceiling really important, spending in generally really important, and all the legislation that voters care about at the moment is just not getting looked at.
So, sure, if you think about this holistically, this has huge implications, of course, for the workings of the House of Representatives, for the U.S., for foreign policy, for the economy. where do you think, I mean, what does it change longer term? What will be the long-lasting impact of this?
Well, the signal that it's sending is that this is now a Congress that seems centered, or at least the majority seems centered around dysfunction, right? It's about blocking things. So the narrative is it's better to get nothing done than to make any concessions whatsoever. So then in that environment, when you have no compromise in politics whatsoever, again, everything freezes, nothing happens, and sooner or later you're going to run up against the debt ceiling. And then you end up with a government shutdown.
And so if you're an ally right now, like, how do you look at this? I mean, through all of our reporting, and I know there's like 550 angles to this, what will you be focusing on the next couple of weeks?
I mean, I think in terms of the foreign partners, there's not much they can do. I mean, you would hope that they're sort of saying, well, you know, maybe it's time for compromise, but fundamentally this has got nothing to do with the allies, I don't think.
Yeah, Stuart, thank you so much, as always, for making us smarter on some of the main topics. Stuart Wells there from Bloomberg. Now, first, Abu Dhabi Bank said they looked at a bid for Standard Chartered minutes after Bloomberg reported they spent months exploring options, including a takeover. Now, the bank's shares jumped after the announcement on Thursday, despite FAB saying it's no longer evaluating an offer. Now, for more on all of this, we're joined by Tom Metcalf, who runs our UK and Middle East finance coverage here at Bloomberg. So, Tom, first of all, how's the story being viewed in the city?
Well, it's definitely seen as big news, even though FAB have come out and said, hey, we're no longer pursuing a bid. I think primarily because, you know, it's just a reminder to everyone, hey, Standard Chartered, that is a pretty interesting sort of M&A target. And, you know, I think, as ever with these stories, just the fact that someone was looking at it may well encourage other people out there. And, of course, FAB have kind of released they're under 6 months of they can't make another bid, but they did introduce caveats saying, hey, if other people make a bid, we may come back and look at this.
So what do you think will happen next?
I think we're going to see Standard Chartered effectively in play, and whether that just means, you know, the speculation about, might some other bank be interested, or, you know, kind of, you know, the actual management coming out and saying, hey, you know, this is why we think Standard Chartered should be independent. Either way, there'll be a lot of chatter about it, and I think, you know, it'll be certainly one of the sort of top M&A topics for the next few weeks.
So, Tom, if you zoom out a little bit, what does this mean for the broader banking sector? Are there going to be, you know, companies and banks like Standard Chartered, where a book to value is quite cheap, that will automatically become takeover targets?
Yeah, I think that was one of the most interesting things to come out of the analyst notes responding to this. It was really the sense that, you know, this is bigger than Standard Chartered. It's not like Standard Chartered stands alone in being seemingly well valued. And there's lots of interesting targets out there. Obviously, on the lending side, perhaps some of the smaller banks, the fintechs. So I think what it really means is 2023 could potentially be quite an interesting year for M&A.
Tom, thank you so much. Tom Metcalf with running a team that will not sleep in 23 because of all the news. Coming up, as the UK is gripped by a series of strikes, the government plans to set minimum service levels in essential sectors. So we'll have plenty more of that story next. And this is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
Quite a lot of movers actually here in the UK today. We take a special look at, Shell and Standard Chartered. So we start with Shell. This is an extremely important company. Gas trading earnings higher despite some of the troubles they had with LNG. Now, it's interesting to look at Shell because on the back of Exxon, there was a lot of worry that if you didn't have the right side of the trade bet, then you would suffer quite significantly. Now, the overall impact on the energy giant's bottom line does remain uncertain because there's this trend of falling energy prices. Remember, Exxon said its fourth quarter earnings took a hit of about $3.7 billion from weaker oil and natural gas. Now, the other story we're watching out for, of course, is Standard Chartered. This was the story yesterday and still remains a story. It came from a nice Bloomberg scoop yesterday, so congratulations to the team that broke that for us. Standard Chartered now facing fresh questions over the future, its future, after it had interest from Abu Dhabi First Bank. It did reveal it had looked at Standard Chartered, but then it said that it's no longer evaluating a possible offer. Now, let's get on to politics and the economy. There appears to be some movement in the industrial action by nurses, with the head of their union telling the health secretary to meet halfway on their demand for 19% pay rise. Now, could this be some good news for the Prime Minister ahead of Parliament resuming next week? Now, for more, we're joined by Bloomberg's Lizzie Burden. Lizzie, a bit better news, I guess, certainly compared to yesterday.
Yeah, a bit of optimism, but remember, it would still be a major precedent if the government went even halfway, because as you say, the nurses are asking for 19%. The independent pay review body originally suggested 4%, so to meet in the middle would still be double digits. The government itself is trying to present itself as reasonable here. It's saying, well, it's dangling a big carrot at the unions and saying we'll discuss pay settlements for 2023-2024, but it's also got a big stick, a new one, on anti-strikes legislation, which would cover the essential sectors and say that if the basic level of service isn't provided, then those employees who are striking could be fired and the trade unions could be sued. So ideally, from the government's perspective, that would put a stop to the current chaos, but it would also prevent it happening again. Now, that could it could face opposition in the House of Lords, it could face opposition in the courts from the unions, and if Labour get into power, they could repeal that legislation.
So we've had the first week full resumption of work, certainly for the Prime Minister and his main opposition. How did they do?
Well, it's been Sunak versus Starmer in the speeches this week, but sadly for both of them, the headlines today are dominated by Prince Harry, not either of them. In terms of the speeches, if you look inside the papers, Starmer's criticised by some of them for using the Tory language of Brexit, take back control, and applying it to devolution. And he's also criticised for not being positive enough, not giving enough detail. Take a listen to the man himself.
I thought his promises were weak and low ambition. Inflation's the biggest example of that. Saying you get inflation down at a rate lower than is already predicted is not a big promise to the British public. And the idea that after 13 years of failure you can come along in the 13th year and say, I've got 5 new promises, please give us one more chance, I just feel is so far removed from reality.
I'm sure I'm not the only one who raised an eyebrow at those rolled-up sleeves when Keir Starmer went on to talk about Labour needing to roll up its sleeves and get on with the job of government if it gets in. But the Times says on balance it was Starmer who met the challenge of whoever would be the next PM.
Great, Lizzie, thank you so much for a terrific briefing, Lizzie Burden, there on what's happening in the UK. Now, we'll continue our coverage of all of the top UK stories every Thursday, 9:30 a.m. It's our half-an-hour special right here on Bloomberg TV. It's called Bloomberg UK, and really, you can't miss it. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. China's planning to restrict restrictions on developer borrowing, dialing back the stringent so-called three red lines policy that exuberated one of the biggest real estate meltdowns in the country's history. Bloomberg understands Beijing may allow some property firms to add more leverage, as well as pushing back the grace period for meeting debt targets. The easing could mark the first most dramatic shift in China's real estate policy to date. Now, Ukraine has dismissed as a ploy Russian President Vladimir Putin's call for a 36-hour ceasefire for Orthodox Christmas. Meanwhile, the US and Germany will send armored vehicles and an additional Patriot air defense system to Ukraine, a significant upgrade in firepower sought by the President Volodymyr Zelensky. And US authorities are ratcheting up pressure on Sam Bankman-Fried's inner circle. This, as Bloomberg has learned, former close FTX associate Nishad Singh is being probed. The scrutiny of Singh, who until recently lived with Bankman-Fried in a Bahamas penthouse, presents a latest legal threat to the FTX founder. Singh hasn't been accused of any wrongdoing. His lawyer is declining to comment. Global news 24 hours a day, on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much, Leanne Gerrans in London. Now, let's look at some of the movers. If you look at what assets are doing at the moment, look, the focus really will be on that jobs data in the U.S. So for the moment, U.S. futures and stocks here in Europe are pretty subdued, but it's the U.S. jobs data that will help, we hope, chart the path forward for the Fed monetary tightening. If you look at the Treasury 10-year yield, it was pretty much steady after climbing for the first time this week. Again, we did have quite a lot of comments from Fed officials yesterday, and so overall we saw a bit of dollar strength, the yen falling to levels not seen in a week, and this is also after the Bank of Japan unveiled further unscheduled bond buying to control its yield curve. Coming up, we focus on the outlook for the year ahead for investors in the Asia-Pacific region. That's next, and this is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
Moment news breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Jobs in focus. Global stocks and futures edge higher ahead of the key U.S. payrolls report, while St. Louis Fed President James Bullard says rates may soon start bringing down inflation. First, Abu Dhabi Bank confirms it weighed a bid for Standard Chartered, but says it's no longer evaluating a possible offer, while shares of the London-based lender are paring some of their losses. Plus, the fight drags on. Kevin McCarthy fails in his 11th attempt to become House Speaker. Allies struggle to reach a deal with dissidents to win their votes. Now, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, when you look at the markets, there are probably 3 big stories that we want to talk about. Now, this is what I picked. First of all, we need to spend a bit of time on the Bank of Japan. Also, Governor Kuroda stepping down in April. So this could really change everything in terms of what we think. And remember, cast your mind back to that surprise decision in December, which generated speculation that the central bank may actually choose to adjust policy again this month without warning. The BOJ's next policy meeting will conclude on January 18th. Again, if you look at what we saw with Japanese yen, but also some of the yields that go with it, a sustained rise above that level risks leading to runaway speculation that the BOJ will raise its yield ceiling further, where there's also a lot of talk about, of course, them abandoning its policy of negative short-term interest rates. If you look at yen, currently 134.45. Now, the other big story, and we haven't spent quite a lot of time on it, but of course this is of sterling. Now, there is a link between weak sterling and Standard Chartered, but the attention that really caught my eye in terms of UK today was house prices on track to drop 8% this year. So this is an extra 8% lower for house prices in the UK for 2023. Now, this is the most since 2011. It already declined for 4 months in a row, and very quickly, Standard Chartered. It's falling after analysts say they consider a takeover of the lender as unlikely given the deal complexity. Now, it's often touted as the world's most dynamic region, but following a mixed year for investors in the Asia-Pacific, as a strong dollar and COVID lockdowns in China posed significant headwinds for the region, analysts also see signs that they should be optimistic, maybe more optimistic in their outlook for the year ahead. We're now joined by Jane Andrews, Chief Investment Officer and founder of Bamboo Black Asset Management. Jane, thank you for joining us today. As we head on to 2023, there are many question marks about China, the reopening, and exactly what that will look like. Where do you see the biggest opportunities in that region?
Yes, I think, Francine, that it's a key moment for China, having done this U-turn on COVID policy and now opening up significantly faster than I think any of us ever imagined. That I think this is going to be a real positive for Asia this year. In terms of equity valuations as well, are very supportive in Asia. I mean, when we were at the end of October, which I think was the nadir for really the China outlook, valuations were there at 30-year lows, which we hadn't seen for decades. So I think now that we are getting this increasing confidence that China is moving forward from COVID, and I think the other thing that's important is that at the Economic Working Committee in mid-December, they announced that stability was the priority objective for 2023. So policymakers have pledged. Sorry?
Yeah, no, go ahead. I mean, I was going to ask you, Jane, you explained it beautifully. What does that mean for your actual investments? Like, concretely, what do you buy or what do you sell right now in China? How do you play it? Do you have to have a partner on the ground?
I think that you don't necessarily need to have a partner on the ground. I think that you can have excellent research, excellent access in terms of from where you're based in London. I think London is a great place to look at Asia. You don't get caught up in all the noise. You can stand back and assess the markets. And I think in terms of where to look, consumption, the consumer, they have said that they want to boost the consumption, they want to help the consumer. And I think that we've also seen a significant change in policy towards the internet companies. So the internet companies, if you remember, with Ant Financial, the IPO got pulled in November 2020. And so we've had 2 years of regulatory headwind. And now this has started to change. They've announced that they are going to be more supportive of the internet companies, and just in the last couple of days they've announced that the Ant Group can raise capital. So I think large internet companies are an interesting place to look. I think EV continues to be an area where we like. We think there's policy tailwinds there, and also healthcare infrastructure. There's a real need to increase the healthcare infrastructure, especially in sort of some of those third, fourth tier cities.
So, Jane, when you look at Asia Pacific, I mean, how is Japan maybe the most interesting one? I don't know whether that brings much more volatility. So for an investor, you have to trade much more cautiously. The market is definitely taking a bet that post-Corona, we're going to have different policies. Do you agree with that?
Yes, I think that it is looking like that could certainly be the case, because the recent inflation numbers came in, core inflation for November came in at 3.7%, which is the highest in 40 years. Also, with Japan opening up, more tourists, a shortage of labour, unemployment at 2.5%. I think that it will be very interesting to see the spring shunto when we get the wage increases. If we get wage increases above 2%, then this will also fuel inflation. So I think that the markets are telling us that there's going to be more to go for in terms of yield curve control, maybe increasing that and widening that further, and then potentially with a new governor coming into the position, that will potentially lead to rate increases, which we obviously have not seen in Japan for decades. In terms of the market, you're seeing the financials, banks, regional banks, insurance companies have broken out of the trading range. So I think that this is a real sea change in Japan.
Jane, we have a viewer question, so thank you, first of all, to all of our listeners and viewers, and thank you even more if you're sending questions in. So this viewer is asking, how do you, Jane Andrews, navigate China A share versus H shares versus US ADRs?
Okay, well, we don't actually have any Chinese ADRs, as we feel more comfortable buying the H shares. And as we have seen, there have been many dual listings over the last few months, and that will continue. In terms of the A shares, we like A shares. We have exposure to selective A shares, and in terms of the H shares, they are quite often trading at discounts to their A share counterparts. So for now, we're very much focused on H shares and A shares, even though I think that the concerns over delisting, I think that those are beginning to potentially recede. But for us, we focus on the local markets.
Jane, thank you so much for all of the insight. Jane Andrews, our Chief Investment Officer and founder of Bamboo Black Asset Management. Coming up, sustainability in focus. L'Oreal brand Garnier says it will end the production of its makeup wipes globally by 2024. Well, we speak to Adrien Koskas, Garnier's global brand president. That's coming up next, and this is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, Garnier has announced what it says is a major new green initiative. The company owned by L'Oreal says it will end the production of the makeup wipes this year in the US and Europe. But globally, it will do so by 2024. Now, joining us now is Adrien Koskas, Garnier's global brand president. Adrien, thank you for joining us. Now, this is a major, major landmark, of course, for Garnier, and maybe it will push other rivals to do the same. Are you putting sustainability at the start of the brand, and could that hurt profit, or how are you matching the two?
So, at Garnier, it's about really scaling more sustainable beauty. For us, it's not an opposition between profit or sustainability. It has to go together. It's about making desirable products that are greener, so that work for people. And we know that efficacy is the #1 attribute that people would not sacrifice, but efficacy with more greener or more sustainable product, with more sustainable packaging, more sustainable formulas. The example you're giving on wipes is very good. So we're stopping the production of wipes in the UK, in the US, in all of our markets actually by the end of next year. And it's a key market for cleansing. But we know we have a product that is better than wipes, that delivers better, which is the micellar water you can see here, that is now made of 100% recycled plastic. And that we can use with a reusable eco pad, so you don't waste wipes or cotton pads every time you use a micellar. So the idea is really to give to consumers sustainable solutions that work for them at scale.
But Adrien, I have to say kudos for actually being able to handle this live on live TV. I'm not so sure I'm as good as you with putting props on TV. When you look at the price point, so I know you're very mindful also of how much things cost because of the cost of living crisis and higher inflation. But have you seen some of your consumers change habits because of it? And again, what does that mean for Garnier's products and where you want to be focused on?
You know, Garnier is a mass brand with a mass appeal. We're in the middle of the market, and our mission is really to make sustainable products accessible to all. There's been, some strong impacts on raw material costs or packaging costs, and we're trying to mitigate those so we can remain an accessible brand. And I think in this time of inflation, we see that consumers are more and more demanding with the products they want. They want products that work, but also, that deliver more for them in terms of sustainability and being more natural and committed. And it's really the mission of Garnier is to provide those products.
I know you've also had a big push, for example, in some of the shampoo bars that are more sustainable, that some of the reusable pads also that are far more climate friendly. How have those sales been going?
So on hair care, we've had two major innovations. You're right. The first one with the shampoo bars, that was almost 2 years ago now. We've had a rather okay success. It has not been major. Some markets have been more successful than others, but it's not scaled in a big way, but it was a really good first innovation. And last year we've launched non-rinse conditioners, which is I'm going to do another trick. This product here, which is a product that decreases by minus 90% the carbon emission, minus 75% plastic of the product, because you're removing one step in the shower, and most of the impact of the product comes from the usage phase in the shower and the water usage. So this product has been launched last year. It has excellent reviews and a really good market success, especially in France, for example. And really our mission is to continue to push with those green innovations to scale them and have a big impact on the market.
Your chief executive at Results was saying that the UK is actually experiencing the highest inflation of any market that you operate in. Is that still the case?
Listen, the inflation numbers in the UK are pretty high versus the rest of Europe. But for sure, like I said, we're really trying to mitigate that and remain accessible at Garnier.
And I know there's also been a huge push in your recent product labeling initiative. Has that made a meaningful impact against greenwashing? Are consumers noticing? Or is it difficult, at the moment to really break it down because of higher inflation and the cost of living crisis?
So the environment score we've developed and we launched now more than 2 years ago at Garnier has been really a first for the industry. It's been worked with 14 different factors, so CO2 emissions or water consumption, with also a third-party verification and scientists, so it's really objective and neutral. It's now a tool that we're scaling everywhere in the world. We just launched in the US, we're present in more than 20 countries. And the big move for next year is that we're going to put this labeling system visible on all of our advertising. We think it's very important to give consumers simple ways to understand what are the products that are more sustainable, which ones are less sustainable. So A being the more sustainable and E being the less. Obviously, we have some D and E products. We're really striving to transform them to A and B. And on top of that, we're also adding, advertising some responsible messaging on how to be more sustainable in beauty.
Adrien, how concerned are you that you won't be able to increase prices as much as you have in the past because you want to be very mindful of people's shopping habits in difficult times?
I think it's about creating value for the consumer. More than prices is the value equation and what you bring to the market. Creating a product that is desirable, both in terms of the packaging, what the formula delivers, and what commitments you can offer in terms of green attributes. So for us, it's not a question necessarily of increasing prices. It's about bringing the right value for the consumer that will justify the right price point and the consumer engagement.
Okay, Adrien, as always, thank you so much for joining us. Adrien Coscas there, Garnier's Global Brand President. Now let's get also to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Samsung's profit has dropped by the most in over a decade, in a sign that the global economic slowdown may be hurting electronics demand even more than what was anticipated. South Korea's largest company has been grappling with weak demand for memory chips, smartphones and displays as consumers do cut back. Samsung's operating profit fell almost 70% for the first quarter, missing estimates by a wide margin. Now, Citadel Securities raked in a record $7.4 $4 billion in 2022, capitalizing on last year's volatility and raising its presence as one of the largest trading units over in the US. Revenue for the market-making arm of Ken Griffin's empire jumped 7.1% from the previous year. Citadel Securities says it's now posted 12 consecutive quarters of net trading revenue in excess of $1 billion. In China, Tesla has made another round of price cuts on its Model 3 and Y electric vehicles. The starting price for a locally built Model Y SUV has been slashed by $38,000. That makes the car more than 40% cheaper than in the US. Tesla is cutting prices as it does face competition in China. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, 2022 was a dry year for IPOs. What's in store for this year? We find out next, and this is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, 2022 was a slow year for IPOs, with investors keeping firmly on the sidelines. That's as inflation, rising interest rates, and war have stoked recession fears. But will things actually pick up in 2023? Well, joining us now, Swetha Gopinath, our equity capital markets reporter. So, Swetha, thank you so much for coming on. I mean, we start the year and we kind of look at 2022 and we think, right, why was it such a dismal year for listings?
Yeah, it was an incredibly quiet year. We went like months without large listings. And that was mainly because investors sort of shied away from the sort of tech offerings, from the sort of growth offerings that had dominated the 2021 landscape. The move to sort of value sectors at a time of higher inflation and higher interest rates, meant there wasn't really sort of appetite for the typical IPO candidate. Now, the move to value is all good for investors looking to make returns in a pretty difficult market, but it sort of poses quite a difficult situation for IPO bankers, because you don't typically have these sort of stable, income-generating, interest-paying businesses looking to list. The typical IPO candidate is sort of tech-heavy, growth-focused, not always profitable, but that's just the kind of asset investors have no interest in at this moment.
So does that change this year?
It hasn't changed yet, but bankers are hoping it will change, at least by the second half of this year. If we have some more guidance from central banks on how interest rates will play out, if volatility comes off a bit, if the VIX index stabilizes, we could see IPO activity pick up again.
So I mean, what's interesting, and actually you really see that through your reporting, which was amazing all of last year and even before that, the bright spot actually for IPOs was the Middle East. Like, what are the dynamics there?
Yeah, the Middle East is quite an outlier, and that's because a lot of the boom there, a lot of the deal activity there is being driven really by higher oil prices. Higher oil prices last year meant that there was a virtual windfall for investors in the region, so they have a lot more cash to deploy. And we also have, at the state level, we have these countries, be it the UAE or Saudi, we have these countries looking to move away from their dependence on crude oil. So we have large sovereign wealth funds, we have these big governments looking to diversify their portfolio, and that's also fueling deal activity.
So what could be hot right now? I know we spent a lot of time talking about Standard Chartered today, and actually how it's Abu Dhabi First Bank that was looking into it, but not anymore. Are there sectors, investors, places where you think there'll be hot or smart money going into?
The Middle East is still going to be a big IPO venue. Bankers say there's a lot more to come from the region. Aramco, which sort of set off this whole listing boom in 2019, they're looking to list their energy business. We have ADNOC looking to list their gas unit. They're also looking to list their logistics unit. And these businesses are worth literally tens of billions of dollars. And in the US, we have Instacart. We have ARM, the semiconductor firm that's likely to list. The London's hoping to persuade ARM to also list here at home. And on the continent, we have the likes of United Internet's web hosting firm, and that actually could come as soon as in the first quarter of the year. So there are deals, but the floodgates aren't open yet. It's very selective.
Okay, take a rest, because I feel like in 2 weeks, it's just going to kick off. So
I hope it does. I'm keeping my fingers crossed.
That's what I got out there. Bloomberg's equity capital markets reporter. Now, we're also looking, of course, at the big possible M&A story. This is Standard Chartered. Bill Winters at the forefront of Standard Chartered with a lot of questions. If you look at the relatively smaller market value, about $24, and the lure of the business with exposure to, for example, Middle East and Africa, whether Standard Chartered could really become a takeover target. We'll have plenty more, of course, throughout the day on this. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Katie Lyons in New York, our Anna Edwards here in London, and this is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different, Mitch and Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg.
The economy seems to be heading for an iceberg in the form of higher interest rates.
Rates have to be higher for longer in order to maintain the downward pressure on inflation, get it to converge to 2%.
Businesses will try to hoard labor. We're looking for a slowing down in hiring. We're not looking for a wave of layoffs.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Figuring out what the Fed will do next on interest rates. Today's U.S. jobs report could be a big factor. Making history on Capitol Hill, a fractured Republican Party has now gone 11 rounds of balloting without being able to elect Kevin McCarthy as Speaker. And buying a Tesla in China is now 40% cheaper than in the United States. The electric car maker just cut prices again to deal with growing competition. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And it's jobs later today, of course, Kaylee, over in the United States. I guess one of the questions is, will we focus on resilience in the labor market, or will cracks continue to emerge?
Well, judging from the data we've already gotten this week, Anna, that slack in the labor market doesn't seem to be forming yet in a material way. We'll see what the headline payrolls print tells us, but also wages are going to be very key to focus on today. Of course, traders in Asia had to make their moves before getting those data points in about 3.5 hours time. So largely it was a muted day overall. The MSCI Asia Pacific Index almost unchanged, up less than 0.1%. Where you did see some outperformance, though, is in Chinese property developer stocks. This is after a Bloomberg scoop overnight that China is looking to ease that so-called 3 red lines policy that really has hindered developers. So that gave a lift to those stocks by about 1.5%. Another individual stock worth pointing out from the Asian session was Samsung. Reported earnings, fourth quarter missing expectations, the biggest profit drop in more than a decade, really suffering from the slowdown in demand for electronics and therefore chips. What is interesting, though, is the stock still ended the day higher by about 1.4%. And analysts actually say because profit is deteriorating so much, that probably means it is more likely that the company is going to start cutting back on supply and capex. So maybe clinging to some optimism around that narrative there. And finally, in foreign exchange, I would note the yen is weaker against the dollar by about 0.7%, the biggest underperformer in terms of Asian currencies against the dollar right now. Dollar yen trading at 134.39. This is after another Bloomberg report, Matt, that the BOJ isn't feeling much pressure to make more tweaks to yield curve control, which of course is what the market has been betting on after they made those adjustments last month.
Yeah, it doesn't seem like the market is pushing as hard as it has
in the past. I want to just point out that we're not seeing a lot of movement here in terms of futures. Of course, as we tell you, every time there's a big release like this, we tend to see very low volume until the numbers come out. So waiting for non-farm payrolls, we have S&P futures, little change, still in the red, and we had a big down day yesterday again in U.S. stocks. So not a great start to 2023 if you're long. The 10-year yield right now up about 1 or 2 basis points to 373.47. Not a heck of a lot of movement there either, nor do we see a lot of movement in crude, gold, Bitcoin. I scoured all the assets, and in terms of what's going on in the U.S. markets right now, it's very calm, Anna. So crude at 74.07 a barrel for West Texas Intermediate, and gold at 18.35. We'd seen, I think, a really interesting run-up recently, but it seems to have stalled right around where we are, and I guess the non-farm payrolls numbers could change everything. You've got some big data out of Europe as well.
Yeah, absolutely. Non-farm payroll is certainly the focus later. Right now, we've just had the Eurozone December inflation prints, and I'll just linger on those for a moment. This is the mixed picture we have for European stocks in the meantime. Euro area then, December consumer prices on the rise, and really it's the core number we want to focus on, but the rise in the overall number, 9.2%, that is below the estimate, so it seems like a good story. The estimate was for an increase of 9.5%, and it's around 1% weaker than the prior reading. So that all sounds good if you're looking for inflation to come down. But the core inflation print is where there could be concern. Euro area core inflation accelerating to a record of 5.2%. And this goes some way to pointing out some differences across the Atlantic, perhaps, or some lingering inflation concerns, at least here in Europe, when a lot of people point to the fact that, yes, you've got this volatile gas price that is weighing in a lot, but it is the stickiness of that core number that will be a focus for the ECB. We have seen a bit of movement in the euro. You've got the 105.12. I think it just showed up on your screen there. We have seen the euro pulling back from earlier losses as a result of this number, but not an enormous amount of movement there. On to some stock specifics for you here in Europe, making some news, and Shell is one of those. The business up by 1.6% this morning, the share price higher. This on the back of a trading update where they said that their gas trading business had done very well, better than some had anticipated, and so that's a positive story despite some issues they had that their LNG business in Australia. Standard Chartered, this is the UK emerging markets banking business, down by 1.3% today, but this on the back of strong gains yesterday, up double-digit percents at one point, ended the day up by more than 6%, pairing those gains a little bit today. This, as we've heard from First Abu Dhabi Bank, that they have been interested in Standard Chartered, no longer, but that certainly was an interesting one to watch for 24 hours or so. Stellantis, the automaker, down by 1.5% this morning. The business over at the Consumer Electronics Show, in fact, Matt, over in the United States, the CEO of Stellantis talking about how you can't just keep running costs that you're not using. You can't run infrastructure and production facilities that you're not using, and so suggesting you might need to pull those back a bit. And I just put in the natural gas price because this has been incredibly volatile yesterday. We saw an 11% gain yesterday, 5% higher today. The overall story over the past month has been for weakness in the gas price because of warmer weather, but we'll keep an eye on that one.
It's so strange to think that Stellantis, you know, this global conglomerate, but that I think of as European, as French almost, owns and produces the Dodge Challenger Hellcat. I just can't get over that, but this is the last year, I guess, for that. Now, today's U.S. jobs report will help determine what the Federal Reserve does next on interest rates. The estimates are for employers to add fewer jobs last month. That indicates a cooling in the labor market that would reduce the need for higher rate hikes, but the data released Thursday, the ADP data, as well as jobless claims, shows that the market is still very resilient. Joining us to discuss is Marcus Ashworth, Bloomberg opinion columnist. And Marcus, I note that the whisper number is also considerably higher than the survey number at 225.
Well, actually, I was still expecting things to be around 200-ish, and I think the market won't really move if it's in that 250, 200 area. You know, as you guys mentioned earlier, I mean, the key thing really is average hourly earnings. That's expected to dip a little bit down from 5.1 to say 5, and the monthly print for 0.6 down to 0.4. If we don't see that, i.e. we see stronger or sustained hourly earnings, that's going to spook the market. You know, really, the Wall Street's expecting nothing here. We're priced for a snoozer. But what's happened this year in bond yields, they've dropped quite substantially in the sense of the start of the year just below 4% and now down at, say, 370. So if we don't get should we say, a benign number, then I expect bonds will have a very tough day.
Yeah, interesting in the context of some of the data we got yesterday then, Marcus. I mean, you say we're positioned for a snoozer. Yesterday, though, we got ADP and claims data, both underlining the resilience of the labour market and triggering some movement in treasuries.
Yeah, and the thing is, everyone's been fooled by the ADP too many times. It very rarely correlates. In fact, it's amazing how badly it correlates with payrolls. Obviously, jobless claims is something everyone's keeping a sort of a lazy eye on, because that's obviously the most up-to-date data we can see. But really, it's going to be payrolls all year now. You know, the CPI number is important, but payrolls and that wage data within it is what all the market cares about. That's what's going to drive the Fed. We've got, 3 Fed hawks out already this year, talking about higher terminal rates, 5.4 from Kashkari. But we know we've got 4 dovish new people coming in on the FOMC. The nature is going to change. We're expecting 50 basis points next move, and maybe that's it, or maybe a 25 basis points after that. Lot to play for, but the bond market doesn't believe the Fed hawkishness. Unless we get a really, really strong payroll number, I don't think the market's going to get away from that dovish approach to and thinking rates will do quite well.
All right, well, we'll find out in less than 3.5 hours' time. Bloomberg Opinion's Marcus Ashworth, thank you so much. Let's turn now to politics, because the chaos on Capitol Hill continues. Republican Kevin McCarthy has been blocked for the 11th time in his bid to become Speaker of the House of Representatives. That's a post-Civil War record. The group of 20 GOP hardliners who refused to vote for him have yet to agree on a deal that satisfies their demands. Bloomberg's Mark Champion is joining us now for more. Mark, if the concessions made thus far are not enough, is anything going to be?
Yeah, it's a really good question. I mean, the history of this is sort of interesting to watch. You know, this is, as you said, it's the most times that they've had to vote since the Civil War. Before the Civil War, you had them voting 44 times, taking 2 months. And there's no sign yet that McCarthy thinks that he can't do it and that he's going to have to step aside and let someone else. So I think we're in kind of uncharted territory. We don't really know just how long he's willing to sit there and stick it out. And we also don't know, what the alternative, game plan would be for someone else to come in and take it. Well, we have a very sort of, serious rift between, the mainstream Republican Party and, its right wing. And that rift is becoming wider and more difficult to manage.
It could be just a media pipe dream, Mark, because I first heard this from Anne-Marie Horder yesterday on Balance of Power, and then I think I heard Derek Wallbank talking about it this morning on Bloomberg Radio. But what's the possibility of a unity candidate? I mean, could there be some centrist or more liberal Republicans that go over to the Democrats and say, hey, we've got, this guy who could be acceptable to you, and in return we won't impeach President Biden?
It does sound like a little bit of a dream. What you're talking about there is the kind of compromise-based constructive politics that maybe used to happen 10, 15, 20 years ago. At that time, you might have thought that sort of thing could be done. There were like-minded people on either side of the aisle in the different parties. We haven't been there for quite some time. It would be a big surprise. I mean, in a sense, it would be a good surprise, because the key thing here is, what's going to happen when you get to big issues like, the budget, and whether you end up with a stalemate over the budget again, which is extremely damaging, and especially given the state of the U.S. economy, the state of the global economy, it's what you really don't want to see. And what we're looking at right now, this kind of stalemate within the Republican Party, if we end up with the right wing of the Republican Party really having sort of asserted itself, it's hard to see how those kinds of big issues get resolved in a constructive way.
Yes, and whether that win continues to assert itself in future debates. Mark, thank you very much. It is, of course, January the 6th, which won't have escaped a lot of people's attention, an anniversary of the storming of the Capitol, of course. Mark Champion, thanks for thoughts on US politics. Let's move to the auto sector. Tesla taking a hit in pre-market trading after announcing another round of price cuts in China. The starting price for a locally built Model Y SUV has been slashed to $38,000. That is 43% cheaper than in the United States. For more, we are joined by Bloomberg Quick Take's Alex Webb, who's been following this business for a long time and all things tech, I suppose, where autos meet tech. Alex, your thoughts then on this price cut in the Chinese market? Is this a China-specific story? Is this an EV story? What's happening?
It has big implications for Tesla globally, but it is a China story, namely the competition in China. A lot of EV makers in that market has really heightened. Now, the reason that's significant for Tesla is that about just over 50% of all its deliveries globally were made in China. So if it's cutting prices there, it obviously means two things. Firstly, competition is steeper, therefore you might not be selling as many. And secondly, those that you do sell, you're probably going to have a lower margin on. So it's not good news, and therefore that's why we're seeing a slight, negative reaction in the pre-market.
And horrible for U.S. customers. Imagine buying a Tesla for full price and then realizing that your Chinese counterparts get it for 40% less. That would make me very unhappy.
Well, Matt, now you know what it's like being an iPhone customer in the UK and seeing the prices in the US.
Yeah, no, that's a very good point. Samsung profit, speaking of phones, dropping by the most in more than a decade today. What's driving that, Alex?
So yeah, it was a 69% drop in profit. Samsung, unfortunately, has double exposure here because what we're seeing is a slowdown in the consumer electronics market. There was a huge boom during COVID. Some people had spare money. They were able to spend on electronics. Now, not only do they have a lot of electronics, but there's the cost of living crisis, which means that the spending is not as fulsome as it used to be. Samsung not only makes those electronics in the form of smartphones and other consumer devices, it also makes the chips that go into them. So the people it's supplying maybe don't need as many as they did before. There has been oversupply now in semiconductors, having been a shortage maybe a year and a half, 2 years ago. So ironically, Samsung shares actually trading up because there is a deal reported in the offing in the semiconductor space that would improve the pricing for Samsung. So that's the hope that actually if there's some consolidation, prices will improve. But at the moment, it's not looking brilliant.
All right, Bloomberg Quick Takes, Alex Webb, thank you so much. Now let's take a quick look at some other company stories we were watching this morning with stocks moving in pre-market trading here in the U.S. Have to begin with Bed Bath & Beyond because this stock fell 30% yesterday to the lowest level since 1992 after it said there is substantial doubt about its ability to continue as a going concern and it might have to file for bankruptcy. Then Bloomberg reported last night that it is already preparing for that filing. And as a result, it is adding to those losses in pre-market this morning, down 12% to less than $1.50 a share. Remember at its peak back in the meme stock boom of 2021, it was north of $50 a share. So a remarkable fall from grace for this once retail favorite company. Now, another stock to keep an eye on is Southwest. Of course, it's been in the news a lot in the last several weeks due to the meltdown it suffered during the holiday period. More than 15,000 flights canceled, and the company saying yesterday that it is going to give updated guidance on its fourth quarter after that episode. We don't have those numbers yet, but still something to watch. That stock is up about 1/3% in pre-market. Another stock moving more substantially higher is WWE, World Wrestling Entertainment. This is after news that the former CEO and controlling shareholder Vince McMahon wants to come back and is actually looking at potentially a sale of the company. So that stock is up about 8.25% before the bell, Anna.
Okay, wrestling. Not something we talk about very often on this program. I won't dwell on the subject. Coming up, we will talk to Lale Ancona, who joins us from BNY Mellon Investment Management, Senior Market Strategist. What is she expecting from the jobs report, and what does her strategy for 2023 look like? European stocks have outperformed US ones. Is that a viable strategy? And on the US jobs report, we will talk specifically about the US economy with Josie Dent, Center for Economics and Business Research, managing economist. We'll get her view on the jobs story stateside. Plus, later today, we'll get the view from the White House with the U.S. Labor Secretary. Martin Walsh joins the team. That is at 9:45 a.m. New York time. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it.
You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual.
I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York with Kayleigh Lyons. Anna Edwards with us out of London. Now, something Anna Edwards said on Bloomberg Radio the other day made me so jealous. And I had our producer in London, Dan Curtis, make a chart. Indeed, it's true that Europe is really outperforming U.S. when it comes to stocks. Okay, it's only been 1 week of trading thus far. Nonetheless, this kind of trouncing makes me wish I were back in Berlin, frankly. Let's bring in Lynn Thomason, Bloomberg Markets managing editor. So, Lynn, I guess the U.S. was always so tech-heavy, and that's why we outperformed. Now, that's not such a good thing, and Europe has taken the reins. What's going on?
Yeah, absolutely. I mean, it's really going in reverse, that all the money's coming out of tech and people are looking for, bargains. I think the warmer weather in Europe really took people by surprise. You're also starting to see some softer inflation figures. And I mean, the fact is that Europe is so cheap compared to the US, which has had a tremendous run over the past few years.
Yeah, the growth story out of China and expectations there are also helping some in the luxury side, aren't they, Lynn? What about, if we go stateside, though, for today's commentary, and non-farm payrolls clearly is going to be a driving force for markets later on. What are you going to be watching?
Yeah, I think obviously everyone's going to be watching the stickiness of the wage growth to see whether we're looking at services still prices increasing as much as we've had. And I think, will jobs continue to surprise on the upside? And does that mean a higher rate path for the Fed?
So essentially, Lynn, good news, bad news, good news, question mark.
Absolutely. I think if you see a really strong U.S. payrolls figure, it's going to be a hard sell in markets. And the reverse could be true.
Lynn, thanks very much. Bloomberg's Lynn Thomason with the latest on market thinking ahead of the jobs report. We'll have full coverage of that for you, of course. If you want more market analysis of the jobs report and everything else that's going on in markets today, MLIV Go is the function to use on your Bloomberg terminal. That's where you find the markets live blog. This is Bloomberg.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. It's a major shift in a Chinese policy blamed for exacerbating one of the biggest real estate meltdowns in the country's history. Beijing plans to dial back the so-called 3 red lines policy and relax restrictions on developer borrowing. Property firms may be allowed to add more leverage, and the deadline for meeting debt targets may be pushed back. Russia is seeking more cash from commodity producers and state-owned companies to help offset the cost of the war in Ukraine. Proposals include a one-time payment from fertilizer and coal companies. Russia's budget has been increasingly squeezed by higher military spending and an economy battered by international sanctions. In the UK, a sign that the nurses' union's position is softening ahead of more strikes this month. The Royal College of Nurses has called on the government to meet it halfway on pay hikes. Nurses want a 19% increase. The government's offering an average of 4%. And U.S. authorities are ramping up the pressure on Sam Bankman-Fried's inner circle. Bloomberg has learned they are now scrutinizing one of his close associates at the bankrupt FTX crypto exchange, Nishad Singh. Singh hasn't been accused of wrongdoing, and it's unclear if he is cooperating with investigators or will do so. But of course, Matt, some of his other former associates, like Gary Wang and Caroline Ellison, already are cooperating and have pleaded guilty. Sam Bankman-Fried, of course, pleading not guilty.
Yeah, and there are others of whom we have heard very little. For example, remember Brett Harrison left in the summer, and I had always wondered what happened there, but I guess we'll find out.
Yeah, him, of course, being the former president of FTX US. Coming up, we'll turn from crypto back to the broader markets. Lale O'Connor of BNY Mellon Investment Management will be joining us. This is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do, and any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine, and in the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Figuring out what the Fed will do next on interest rates, today's U.S. jobs report could be a big factor. Making history on Capitol Hill, a fractured Republican Party has now gone 11 rounds of balloting without being able to elect Kevin McCarthy as Speaker. And buying a Tesla in China is now 40% cheaper than in the US. The electric car maker just cut prices again to deal with growing competition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Matt, European markets not going anywhere really this morning, waiting for the jobs report, so that's quite usual, I guess. A lot of focus on the wage story then after the US later.
Yeah, absolutely. I mean, we'll be paying very close attention to this data, and it's incredibly pertinent to markets. What isn't exactly pertinent to markets, so important to markets now, is the speaker votes in the House. I heard you this morning referencing Spinal Tap, which I thought was absolutely perfect, but of course...
I blame Derek Woolbank for that particular...
I thought it was great. This one goes to 11. In terms of futures right now, we're unchanged, and yeah, typically people don't trade very much. Maybe they even turn off the computers until we get a big data release like the jobs numbers today. I just saw recently the whisper number is even higher than I thought. So the survey is for about 200,000. I think 202,000 jobs added in December. The whisper number is for 244. So the market really thinks this is going to be a big beat, and why shouldn't it, right? We've had 8 beats in a row. The U.S. 10-year yield right now up about 1.5 basis points. So investors letting go of that debt to some extent, although, again, not a lot of movement in terms of the price or the yield here. NYMEX crude is up 1%, but still under 75 at 74.38 a barrel for West Texas Intermediate, and gold just barely budging to the upside at 18.35. I think it's been really interesting to watch lately because it's come up considerably, about 15% over the past few weeks. So it's interesting to see, what does that mean exactly? Is that just because of the dollar weakness that we've seen, or are investors preparing for the possibility of a recession, even the possibility of cuts from the Fed later on in the year by stocking up on gold right now? Kaylee, what do you see in terms of the pre-market movers for stocks this morning?
Well, I want to return to the Tesla story because for the second time in just 10 weeks, they've cut prices in the China market, which of course is an absolutely crucial market for them, and now brings prices of those EVs to about 40% below what the prices are in the US. So maybe that's not great news for Matt Miller, but frankly, it's not great news for Tesla either because this just refuels concerns about demand and competition in that market. So as a result, result, Tesla stock is down nearly 5% before the bell, and it's bleeding through to other EV makers as well. Lucid and Rivian each down in the ballpark of about 1.5%. Then I have to talk about Bed Bath & Beyond too, because yesterday it was a terrible, terrible day for the company, submitting a filing saying that there is substantial doubt about its ability to continue as a going concern, might need to file for bankruptcy. That resulted in a 30% decline in the Thursday session. The stock already at its lowest since 1992, and those losses are compounding this morning. The stock down another 11% before the bell, Anna.
Not moving much this morning here in Europe then, Kaylee. We've got European equity markets pretty flat. We had seen a little bit more movement earlier on, but falling into line with the US futures picture, which, as Matt was saying, isn't moving very fast either, waiting for that jobs report out of the United States. We have seen some energy names moving higher. We've seen some auto names moving lower. Those are the two sectors that seem to be in focus, and I have some explainers for you on both of those. So Eurostoxx 600, pretty flat. The Shell share price up by 1.5%. A trading update out from this oil and gas and energy giant today, talking about resilience in their gas trading, or better than expected performance in the gas trading business. So that's taking the headlines, despite the fact that we don't know exactly how all of this is playing out, including the headaches they had with their LNG business in Australia, how all of that will play out in the bottom line for the quarter. Standard Chartered down by 1.3% after it rallied quite substantially yesterday, closed more than 6% higher yesterday on all of that talk about First Abu Dhabi Bank running the slide rule over this business, considering whether it might want to buy it, deciding not to, but still that is a talking point here in London. And Stellantis is down by 0.8%, paring earlier losses a little bit, Matt, for this auto business. We've had the CEO of the company over at the Consumer Electronics Show in Las Vegas talking about how you just can't run costly infrastructure right now. And so raising the possibility of furlough, of idling some of their facilities, that's the word I'm searching for, as a result of the costly transition, of course, to EVs.
Yeah, absolutely. Really great reporting by Bloomberg overnight on a lot of the EV business and those who aren't really attacking it as much as they could. Let's get back, though, to what's going on in terms of markets right now. Ahead of this all-important jobs number, joining us is Lale Akoner, BNY Mellon Senior Investment Management Market Strategist. Lale, thanks so much for joining us this morning. Let me first ask what you make of the labor market right now, because it still looks so healthy and vibrant, even though the Fed has raised rates 450 basis points in a year. What does this mean for your investment strategy?
Well, first of all, thank you very much for having me. Good morning, everyone. Look, it's still a very interesting labor market. To your point, I think we have around 10.5 million job openings and around 6 million unemployed. So there are mostly like 2 job openings for every unemployed person. So it's tough from the Fed's point of view, given the fact that there are signs that the economy is slowing down in a way, especially from a consumer side. But again, they have to see that number of job openings come down without unemployment rate going too much above 5%. So it's very tough. But we're saying that, look, they will increase interest rates, and they will keep those interest rates at that level for an extended period of time.
So the big focus is on that data today then, Lale. In terms of your equity strategy globally, though, what do you make of the fact that we've seen European stocks outperform US stocks? We're only on the 6th of January, don't want to make too much of it, but it has been a trend that started last quarter and has continued into the new year. Does that make sense to you? Do you favor Europe or favor the US?
Yeah, I think, look, we're basically saying that the US is going to continue to outperform Europe, given the fact that, again, you know, from a macroeconomic point of view, US is going to outperform Europe and Asia as well. But I think for a short period of time, from Europe side, I think the market is basically saying that, look, the ECB has to slow down the pace of rate hikes, given the fact that, again, there's greater uncertainty from the weather point of view, where they have to, again, see whether, you know, consumers are going to come under pressure due to, you know, increased gas prices. I think the market might be reading too much into that. But again, from a long-term strategic point of view, we're saying that the US is going to outperform Europe, given the fact that, again, from a macro point of view, it's in a better position.
And what about the pace of hikes in the US, Lale, given that is our focus for today on the jobs story? We heard from James Bullard of the Fed, not a voting member this time around, but he is still influential, of course, and even he sounding a little bit more dovish. And for somebody who has been so hawkish, perhaps that's significant. He's particularly concerned about money supply and what that could do, the pullback in money supply, what that could do to inflation. I mean, where do you think the Fed heads from here?
I think that there's some of the Fed speak does suggest that they're getting a little bit more concerned about the fact that the financial conditions are tightening very fast. Again, there's hidden leverage around the world that is hard to see beforehand in terms of when you're hiking interest rates. So I read it as, again, the Fed is really being concerned about the tail risk on the left-hand side. So what we're saying is that, look, there is a marginal slowdown in the pace of rate hikes, but it doesn't mean that the Fed is going to pivot anytime soon, which frankly, the equity market is, pricing in at the moment. What we're saying is that, no, they will bring interest rates up to 5%, and they will keep those interest rates at that level for an extended period of time, which means that until the first of 2024.
So, Lale, if the equity market is perhaps overly optimistic on the idea of a Fed pivot, is it also overly optimistic on the outlook for corporate earnings, considering the next earnings season really kicks off a week from today with JP Morgan?
I believe so. We're saying that, look, in the next 12 months, we will definitely see earnings estimates coming down. And the reason why is three factors, really. Oil is up, interest rates are up, and the US dollar is up. It's appreciating against major currencies. These three factors usually does suggest that the earnings estimates are going to come down in the next 12 months. So again, another reason why we're saying that bottom-up stock selection, active asset allocation is the thing to do, because there are some sectors such as energy, consumer staples that are going to fare better than the others. But from an overall market perspective, definitely earnings are going to come down.
How much room to run, really, though, is there in some of those trades, considering they outperformed to such a degree in 2022?
I think it's all very relative. Again, there are some sectors that are going to continue to see less margin pressures relative to some of the sectors such as consumer discretionary, industrials, and so forth. So we're saying that from that point of view, I think there's still some room to run in terms of, again, energy, consumer staples, outperforming. Again, this is going to be a year of margin pressures in the sense that, those companies that are able to translate those higher input costs to their consumers are going to fare better. And I think that the market is going to move and price in that information accordingly.
Lale, thank you. Lale Akona joining us from BNY Mellon Investment Management. Thanks for your time. That's the view on the markets then and how they respond to some of the incoming economic data. Let's get to the data itself, though. Coming up, a conversation with Josie Dent, Center for Economics and Business Research, where she's the managing economist. We'll talk the U.S. economy next. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Well, it is Jobs Day today. That data will be in focus come 8:30 a.m. Eastern Time, with initial jobs claims yesterday lower than pre-pandemic levels, ADP beating, JOLTS beating on Wednesday. We're expecting today's report will still show sturdy hiring here in the United States. So joining us now to discuss further is Josie Dent, Center for Economics and Business Research Managing Economist. Josie, when's the slack in the labor market actually going to start showing up for the Federal Reserve?
It's a good question, and one they're scratching their heads about, because the tightness in the labor market is a key concern for them, and why they continue to raise interest rates despite signs that the economy is slowing. For instance, in November, retail sales contracted by 0.6%. And so why does the Fed keep on tightening? Well, part of it is this very tight labor market. Of course, with expectations of around 200,000 additional payrolls in December, that is a lot lower than the average for the other 11 months in 2022 of 392,000 additional payrolls. So the labor market is slowing, but yet we're still expecting an unemployment rate of 3.7%, which is extremely low.
Right.
Now, it's likely that over the course of this year, actually, unemployment will start to tick up, possibly to around 5%, possibly higher, because we are expecting probably a recession. We're forecasting for this year annual growth in the US of just 0.3%. So it's very likely we'll see, at least 1 or 2 quarters of contraction within that. And that's down from an estimate of 1.7% last year in 2022. So it is likely we'll see unemployment rise, but it's going to be very tight, and today's labor market data is expected to remain very tight compared to historical levels.
Josie, how high does the unemployment rate have to go before it really starts to affect inflation? People talk, or used to talk all the time, about the non-accelerating inflation.
NAIRU.
Exactly, NAIRU. What's the R? I can't remember. In any case, the level that unemployment has to be before it stops supporting higher prices. And a lot of people are saying 4.95% is where we need to be. What's your view on NAIRU, and do you think the Fed really has what it takes to push us there?
Yeah, so there are a lot of formulas you can use to try and estimate a number. And so, yeah, around 5%, which is likely to reach amid the recession, is a good estimate. The Fed has already said it's going to raise interest rates this year. We're expecting increases in at least the January and March meetings. We're expecting a 50 basis point rise in January. After that, it might start slowing or just not be so tight on raising policy rates, because we are expecting the labor market to slacken. But if it doesn't, if it remains very tight, then we could continue to see interest rate rises throughout the rest of the year. And I think they'll be looking at multiple metrics. They've also got to consider, of course, GDP growth. They don't want to push the US economy into a really deep recession just because they're just looking at the labor market stats. So I think they've got to have a holistic view of the economy. But the labor market, of course, is extremely important to consider.
And with that in mind, Josie, I wanted to ask you about some of the comments we got from James Bullard just overnight. He was talking about M2, about money supply, and about the way that is falling. And that is a very rare event, the first time since the 1950s, if the full year data from last year goes the way that it seems to be going. Is this one of the areas we need to focus on to remind us that we've seen a lot of tightening already?
exactly. Money supply is one of the most important metrics when considering inflation. And of course, with all the recent quantitative easing we saw over the pandemic and also pre that, there's been a dramatic effect on the money supply. And now we're talking about, of course, tightening. And so we're expecting, of course, the Fed's recent actions to have an impact on the money supply and inflation. And we're, of course, we're already seeing indeed inflation slowing with a November stat at 7.1%, down from 9.1% peak in June. And it's likely that inflation will continue to slow. So we are seeing an impact of the Fed's recent changes in policy, but it hasn't yet turned a corner. Lots of people want to see more signs that inflation is under control because, of course, 7.1% is still extremely high by historical standards.
We've heard a lot of, a few commentators at least lately say that we could be back very quickly to a low inflation or even a deflationary environment. Michael Burry, of course, tweeted about it a couple of days ago, and that may have been, he may be an outlier, but Raghuram Rajan from the Booth School of Economics in Chicago has said that the Fed needs to prepare for that. What's the likelihood that we get down quickly to the level that the Fed wants to see and maybe even below that?
Yeah, I think across most developing countries, we're expecting inflation to slow dramatically this year. And a lot of inflation is quite dependent on, of course, energy and energy prices. And a lot of that is determined by, political or geopolitical events. Obviously, the war in Ukraine has had a massive impact on global energy prices, and so that caused them to rise dramatically. A quick resolution, of course, could result in a dramatic fall in energy prices, which would likely result in deflation. Similarly, China rapidly kind of loosening its COVID restrictions can also have a big impact on energy demand and have an influence on energy prices. And so it's quite difficult to predict exactly how quickly inflation will fall this year. And in fact, if we could see some deflation, because it's so determined by geopolitical events, but we certainly are expecting inflation to fall further this year.
And we'll certainly look to China for more developments around the reopening over the weekend. Josie, thank you very much. Josie Dent of the Center for Economics and Business Research. Later today, we'll get the view from the White House on the labor story in the U.S. Labor Secretary Marty Walsh joins the team. That's at 9:45 a.m. New York time. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is ahead today. Of course, the big event comes at 8:30 a.m. Eastern Time when we get the U.S. non-farm payrolls, average hourly earnings data as well. That will be the focus as it will play a disproportionately large role in the Fed's next meeting. Then at noon, voting for the Speaker in the House of Representatives will continue following Republican Kevin McCarthy's historic 11th ballot defeat. Then at 12:45 Eastern in Russia, the Christmas Eve service will begin. The Kremlin troops have been ordered by President Vladimir Putin to cease fire around Russian Orthodox Christmas, and that's only going to last, in theory, Matt, for about 36 hours.
All right, if it lasts at all, we'll continue to follow that up. Now, let's talk about what's going on here in the U.S. in terms of the labor market. Joining us for a preview of the non-farms payrolls report is Michael McKee, Bloomberg International Economics and Policy correspondent. So I guess the survey is for 200,000, but the whisper number is substantially higher.
Well, we got some good news this week, or at least some news that pushes people in that direction, with the ADP numbers coming in at 235, jobless claims low, and a rise in the manufacturing payroll survey from the ISM. So at this point, people are looking for continued strength, at least in the establishment survey. 200,000 jobs, as Matt says, is the basic estimate. That probably doesn't include the 434 people in the House of Representatives who haven't been sworn in yet, so aren't getting paid. The unemployment rate not expected to change, and that's a problem for the Fed, which has predicted it will, which means what's the question about earnings? Do we see earnings drop? The forecast is yes, and we're still going to be running at a 5% annual rate, which is too high, according to the Fed. When they look at the numbers, they think it should be in a range of about 3 to 3.5%. Nothing wrong with getting more money, but you shouldn't get so much money that it starts to push inflation higher, and that's what they're worried about. So that's what Wall Street's going to be looking at today.
Okay, so all of those are headline figures. Beneath the surface of the data, are there any interesting nuances you're going to be looking for in particular?
A couple of things. One is the prevalence of service industry jobs versus goods industry jobs. Goods industry jobs have been falling off, where service industries have been pushing up. And that's where the wage pressure's been in service industries, because there's a shortage of labor. And so they're being forced to pay more to get people to come back to work. The other issue is this household establishment survey dispute. The Philadelphia Fed added up all the household survey jobs and says over the last year we've gained 12,000 jobs, whereas the establishment survey has shown us more than 1 million jobs. And so therefore, which one is right? We don't really know at this point. It's going to be interesting to see how much they diverge this month.
Mike, just briefly, I mean, jobs often seen as a lagging indicator by some. How much emphasis is the Fed really putting on this versus inflation?
It's the average hourly earnings, Anna, that people are going to be at the Fed watching rather than necessarily the rate of job creation. They are lagging indicators. The unemployment rate usually doesn't start to really rise until a recession has already started.
Yeah. Okay, Mike, thanks so much. Bloomberg's Michael McKee with the preview of the data that he is watching. A big focus on the wage numbers then. We will have full coverage, of course, of this data print as it lands. That's it for early edition, but the surveillance team will be on deck next. Tom, John and Lisa to talk about what's going on in the labor market. They'll be joined by former Fed Governor Randy Krosner and BlackRock's Jeff Rosenberg. This is Bloomberg.
standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Right now, what we're seeing is a very strong job market.
The Fed has to drive up the unemployment rate sufficiently to slow down the economy, to generate slack in the labor market.
What we're likely to see is slower and slower and slower non-farm payrolls. It's important not to get distracted by what's happening with the layoffs in the tech sector.
It's industry by industry. And that is why this is such a difficult labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures basically unchanged this morning. 202K. TK is your number.
That's the number today, and it's going to be really interesting. I think there's a mystery to this. I think it's a mystery report. We really don't know. First of the year, end of December look. As Mike McKee says, lots of labor noise statistically. To me, it's a big toss-up here at 8:30.
You know, 8 consecutive months, payrolls have surprised to the upside on the day.
Yeah.
It's been beat all the way back to last spring.
I've been getting my coverage on radio with Paul Sweeney, 9 a.m. Yesterday, James Glassman on, without question, the most accurate labor calls last year. He said this gloom about it is just wrong. And he said, yeah, the tech story's tangible, but that's not the American labor economy.
Well, that's the point. I think there's 2 questions here. Who do you listen to? Lisa, what do you look at? Because the labour market data this week has been great, and then it's been tech firm after tech firm announcing what we've gotten used to over the last 12 months, which is job cuts.
That's what I keep going back to. You can pick your narrative depending on the data that you want to choose. And this is the question that a lot of people have. Why are people not listening to the labour market data more, especially when Fed officials are saying that's what matters to them and they want to get more restrictive? The chart that I'm watching today is Fed funds rates and where the market is pricing in the terminal rate. It has gotten to 5%. It had been around 4.8%, but it's nowhere near where all the Fed officials are saying we're going to get to.
Are we going full Bullard or full Kashkari? Which one is it?
I think that a lot of people are shrugging off Kashkari, but there's not that much difference between Bullard and Kashkari. Bullard is talking about a terminal rate of 5.1. Kashkari is talking about 5.4 with more histrionics.
Wait,
I mean, is there a difference?
My good friend James Bullard said one thing yesterday, and X hours later he said a different thing. They go with the wind. Kashkari at least has consistently been dovish.
What?
Yeah, I think he's been dovish. He's out at 5.4. Others are,
that's dovish.
He's leading
compared to
right
others.
now.
Yeah, I think others are, they're out high 5s. People are warbling about 7. As Bullard moved the market on 7% a couple weeks ago.
Okay, I'm going to turn to the markets. That's the first time I've heard Kashkari called a dove, but we can talk about that later.
At least in the past year.
Yes, in the last year.
Yes, because before he was
uber
dove.
The Kashkari of 2 years ago.
Then definitely dove.
Okay, futures on the S&P look like this, unchanged on the S&P 500. 500 going into payrolls. We are going absolutely nowhere. On the week so far, the S&P 500 heading for a 5th straight weekly loss, longest weekly losing streak potentially going all the way back to May. In the FX market, euro dollar 105.10. Tom, we can talk about CPI out of the eurozone if you like. Headline CPI comes in, but it's looking like core CPI is pretty sticky, and sticky is a problem for the ECB.
Yeah, sticky is maybe the story for 2023, the idea of the when of it all. I mean, everybody can pick their direction, and we can listen to every single guest and pundit we have on, but it's the when of it. And is there anybody really looking with confidence, John, past March 31st? I don't think so.
With confidence?
Yeah, no,
absolutely not.
It's just...
No way.
No way.
The 10-year right now yields higher by a basis point. Lisa, 373.09.
I don't even have confidence going into 2.5 hours from now when we get that December payrolls report. What a lot of people are going to be looking for isn't necessarily the headline number expected to come in north of 200,000. But the average hourly wages, how much do they decelerate? How much do they come down, especially after that ADP report yesterday? All right, put aside how much people discount this. It showed wages growing much more quickly than some of the other official statistics have shown. Does that correlate? Will be really interesting. 10 a.m., we talk about core inflation in the Eurozone, core inflation in the U.S., the fact that some indicators are going down the good side, but services is really the question. We get ISM Services Index for December. We also get factory goods and durable factory orders and durable goods. I'm more interested in services, how much resilient there is there, considering the fact that that really is one of the drivers of inflation at this point. And we get a roster of Fed speak today. We can parse the doves from the hawks. Again, the delta between them, not that great, which I think is indicative of just where this Fed is and how united it is in terms of at least the rhetoric that we're hearing. Atlanta Fed President Raphael Bostic, Fed Governor Lisa Cook, Richmond Fed President Tom Barkin, and Kansas City Fed President Esther Georgetown.
You're running out of breath there, going through those names.
I mean, honestly,
is that enough for you?
We also have other people coming in. We've got ECB chief economist. We have, former Fed head Ben Bernanke. I mean, everyone's speaking today, basically.
Great, fantastic. You excited about that, Tom?
I'm just getting warm and fuzzy.
Lisa, thank you. Steve Whiting joins us now, Chief Investment Strategist and Chief Economist at Citi Global Wealth Management. Steve, Happy New Year to you. Fantastic to catch up with you, sir. The labour market data so far this week, let's go through it together. Job openings, still indicating a strong market. You look at the quits rate, still indicating a strong labour market. Jobless claims, strong. You look elsewhere, the ADP, for whatever that's worth, strong. Steve, what is it right now? Do we have a tight labour market or one that's about to crack?
We have a tight labor market, but let's recall that recessions begin when labor markets have reached their peak, when they've reached the greatest level of progress, right? So it really matters, again, where things will be. What are the dynamics that will add to labor demand going forward? Just think the easy one is the housing market. If you don't have home sales, you're probably not going to need people to build more homes. And if you just think about broad construction employment, all of our full-year declines that we've had in them since going back to World War II have also been declines in broad private employment. What is the need for labor when we have massive increases in inventories? Now, we're not going to worry too much about American manufacturing and that, but marketing, sales, advertising positions, these are things that tell us where labor market demand will be in the next 12 months. And I think it's going to be significantly worse than the year behind us, when we're still trying to catch up with demand.
Steve Whiting, I just looked at Mankiw's Principles of Economics, and you are expert at Chapter 25, which is actually linking the real economy into your strategy and into Citigroup economics. What do profits look like, and what does that mean for the Fed? Greenspan would say it's a big deal. I'm not hearing this conversation in 2023. Is it a big deal?
Right. I think it's a big deal for markets, absolutely. And, you want to think about national income. You might want to think about profits as well as wages. There's a gain for one, there's a loss for the other. And we think that the drop that we will have in profits this year will be low double digits. I think we got some of the action out of the way last year with what happened with financials and some of the consumer areas. But it's going to be a disincentive to invest and add capacity to the economy to rebalance in a stronger way. We'll rebalance in a weaker way, unfortunately, in the economy to get inflation down.
Steve, one consensus that I've heard start to form around the edges is a less offensive kind of view of tech right now. People are talking about tech as possibly having some gains this year because of the cuts that we've heard, the job cuts, the cost cutting. Do you agree that that will actually dampen some of the pessimism and create some upside for tech this year?
Not immediately. Now, in the end, have we had a really severe drop in demand for some of these companies in terms of tech? I mean, there are cyclical components. It's a lot of advertising. There's some that move merchandise around. These are all not very much the same type of tech companies that were all clustered in the late 1990s. What we have had is a big adjustment down in valuation driven by interest rates. The economic impact of a slump probably isn't fully there yet, even in the tech sector and some of the cyclical areas. But I think, again, we'll get out of it. And you can see, again, the tech industries that had a lot of COVID benefits, the adaptations we needed to use tech to make the economy work during COVID, some of that was excess. And I don't view, again, just getting cheap enough because of low rates as really the catalyst for recovery. It will come probably before the year is out, though. Let's just remember how much changes from beginning of the year to the end of the year, how different our years were just in the last few years. So I think, again, we will probably see that recovery within 2023, but not soon.
What's the leadership then for this year?
Well, I think immediate leadership is just defensive, highest quality companies in their industry that have a lot more profits than they pay out in dividends, so they raise their dividends. It's pharmaceuticals. It's some of the non-cyclical industries that have been beaten down. And there are some little anomalies. I mean, China had its hard landing in 2022. We seem to be following that same sort of policy tightening course that can get us a better 2024. They're a little ahead of the game on that, and then they have the unusual factors. But it will be a recovery. I think that the Fed is imposing a severe slowing on the economy, and then the recovery from that will be stronger. So there will be cyclical leadership again, but we still haven't felt all of this in the economy yet. All of these orders numbers, ISM orders readings at 45 is telling us that the goods sector is going to have a big drop, and it's not going to leave all of the services sector employment unscathed.
Steve Whiting of Citi Global Wealth Management. Steve, thank you. Just picking up on the ISM data a little bit earlier this week on the manufacturing side. Not great at all. Echoing some of this, B of A this morning. We think the next big story for markets will be a sharp loss of growth momentum in response to aggressive monetary tightening. They are not constructive on European equities. A prosperous new year, TK. They put a big question mark on that.
This is important. What Steve Whiting just said there dovetails perfectly with his colleague Stuart Kaiser on what Citigroup sees as what's called the jargon is a diminished choice set. You're sitting at your desk and you got to figure out what to do, and there's fewer and fewer ideas, John, because of the new constraints. And of course, one of those constraints is money finally costs something. But I loved what Stuart Kaiser said to us 10 days ago, 2 weeks ago. I love what Whiting says here, that it's just really, there's fewer things to pick right now.
The new consensus on that, though, is buy bonds. If there is something we can agree on, they are lining up to start 23 cents.
Lisa, the conversation yesterday from Deborah Cunningham I thought was brilliant with Federated Hermes. I'm not saying I agree with her, but she said, look, you're going to clip the coupon this year if you're lucky.
Well,
and that's an outlier call.
Well, but there are a growing number of people, and I keep going back to what Rubila Faruqi said, this collision course between the Fed and where market expectations are right now. And they're kind of going to be doing an uncomfortable dance that will create volatility throughout the year. And that's going to create perhaps a premium for a coupon that can give you income to offset that, but not much more.
Looking forward to Priya Misra's view on this. She's going to join us a little bit later this morning from TD. Fantastic lineup for you on this Payrolls Friday. Priya Misra of TD coming up a little bit later. Then we'll catch up with Tom Porcelli of RBC. Following that, Randy Krosner, formerly of the Federal Reserve, and Jeff Rosenberg of BlackRock after the jobs number a little bit later. Looking at your equity market, we shape up as follows on the S&P 500. Equity futures going absolutely nowhere going into this jobs print in a couple of hours' time. We're positive by what? A little more than 0.1%. Yields up almost a single basis point on a 10-year, 372.53. Euro dollar not doing much at 105.06. And what a choppy week it's been for crude. Just about holding on to 74 here, $74 a barrel, and positive 0.5%. On this Payrolls Friday, your estimate this morning is 202,000. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Today's U.S. jobs report will help determine what the Federal Reserve does next on interest rates. The estimates are that employers added fewer jobs last month. Now, this indicates a cooling in the labor market that would reduce the need for higher rate hikes. But data released Thursday show the job market is still resilient. Inflation in the Eurozone has returned to single digits for the first time since August. And that's fueling hopes that the bloc's worst ever spike in consumer prices has peaked. Prices in December were up 9.2% from a year ago. Slower growth in energy costs was a big reason. Republicans making history on Capitol Hill. Party dissidents have blocked Kevin McCarthy from becoming Speaker of the House on 11 ballots. That's a post-Civil War record. The standoff has left Republicans fractured after they reclaimed the majority. McCarthy has offered concessions to hardline conservatives, but so far, he hasn't been able to get enough votes. Russia is seeking more cash from commodity producers and state-owned companies to help offset the cost of the war in Ukraine. Proposals include one-time payment from fertilizer and coal companies. Russia's budget has been increasingly squeezed by higher military spending and an economy battered by international sanctions. And that holiday travel meltdown is prompting Southwest Airlines to revise its financial outlook before reporting fourth quarter results. The airline canceled almost 16,000 flights over 8 days. Southwest says it is assessing the cost of flight disruptions and compensation to passengers for hotels and meals. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. It's the first jobs report of the new year.
The labor market has not cracked.
A lot of that's a function of labor shortages.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Can you walk us through how the Federal Reserve conversation has reset?
We're still seeing a strong economy, so the Fed has to do more.
Why are people so confident that there is going to be some massive deceleration?
I just don't see the evidence.
This could go a lot of different ways.
The December jobs report, today on Bloomberg Television and Radio.
Time for the Republicans to get their act together. And we as Democrats are ready, willing, and able to partner with them to find common ground whenever and wherever possible. Not as Democrats, not as Republicans, as Americans. It's time for Congress to get to work.
That was Representative Hakeem Jeffries, Democrat from New York, live from New York City on this Payrolls Friday. Counting it down to payrolls about 2 hours and 13 minutes away. Your market action looks like this on the S&P 500. Futures positive by just 0.1%, trying to erase some of the losses of the week so far, heading for a 5th straight consecutive loss on the S&P 500. On a weekly basis, in the bond market, yields have been lower through the week so far. Yields trying to push higher by almost a basis point right now on a 10-year at 372.35. We've had some data from Europe this morning. I'll touch on that briefly. Euro dollar at 105.07. We've got a problem with core CPI over in Europe. Clearly, headline inflation is slowing sharply, but core CPI year over year in the Eurozone is still 5.2%. That was actually higher, Tom, than the previous month.
It went up. I didn't know that. Interesting.
On a year-over-year basis,
well, it'd be interesting to see January 12th to get a parallel on that. John, I think it's important to say that the Bloomberg Financial Conditions Index into this jobs report is ever more accommodative. It is buttressed up against recent maximum accommodation.
I think that's a big issue for this Federal Reserve, Tom.
Yeah.
And we've asked the question, are we seeing an unwarranted easing of financial conditions, given their objective to get inflation lower and on a path where they're convinced that we can get back to 2%?
One of the great things we do here at Surveillance is we listen worldwide to experts on a given theme, and it was very good the other day to listen to a professor from Oxbridge in England, Professor Jonathan Farrow, who lectured us on American civics. John, you absolutely nailed what William Cohen, the extinguished William Cohen, Senator of Maine, Secretary of Defense, along with Alton Fry of the Council on Foreign Relations. The Democrats could, however, offer motions to open the possibility of selecting a speaker capable of working across the aisle. Nominating an experienced, respected Republican from outside the House could trigger a contested ballot leading to a speaker in the mold of the original constitutional conception. John, you nailed this.
I didn't say it on air, though, Tom, so I'm not sure it counts, but I'm pleased you brought up private conversations.
Everything we say, even off air, counts. You know.
Oh, boy. Seriously?
There we are. Let's go to Amory Horton.
Can we keep some of the off-air stuff off air?
Amory, I lost count. How many votes are we up to? This morning, this afternoon, rather? Is it the 10th or the 11th vote?
Yeah, I'm pretty sure this morning will be his 12th this afternoon.
12th vote.
At noon, yes.
Okay. I want to talk about this reality. I talked to a bunch of Washington insiders yesterday, and they're waiting for common sense to come in here. And there's an out where somebody from outside can come in if McCarthy, I guess, agrees, or you tell me the process. They mentioned the governor of Maryland, Hogan, and they mentioned the gentleman from Michigan, Upton. Is there even a possibility Upton or Hogan would save the day?
Yeah, Fred Upton's name has been circulating, especially in the Twitter world, but this is really just interesting thinking that this is a West Wing episode. It will not happen. At that point, if McCarthy is unable to get the votes he needs, the Republican will just try for another candidate. They are not going to strike a deal with the Democrats. That is a Hail Mary, and honestly, it's just dream world. It would not happen.
What's McCarthy's dream world this morning? I asked you this question last today. Let's redux it. Who does he call this morning?
It's the same. Well, Punchbowl News is reporting that the Republicans are going to have a virtual conference this morning where McCarthy and his leadership team will go through the new rules. Now, this is the same concessions that we already spoke about the entire week, the biggest one being that one individual can have this motion to vacate, the fact that maybe more Freedom Caucus members could be on the very important Rules Committee, and he would outline this. And, you know, I spoke to an aide of one of these dissenters who said the devil's in the details, and when those details become public. So if McCarthy is able to, and what we're hearing, especially the Washington Post is reporting that there are some of these individuals are starting to move to support him, if he goes to this vote and he starts to ease some of these numbers, right? And you have some of those 20 move over to him and he shows some progress. They're calling that phase one, according to the Washington Post. And then they would move into phase two, which would be immense pressure from conservative Republicans and moderate Republicans to get the remainder on board for him to hit 218. But we should make very clear, if he is able to clinch this, and it could go into the weekend, he will start his speakership very, very weak because he's given away so many concessions.
That's where I wanted to go. The phase one, phase two car wash. Does it leave any moderate Republicans not wanting to support Kevin McCarthy and want to nominate somebody else because of how much he's given up?
Well, the issue is, even if they go to someone in his leadership team, like Steve Scalise, whose name has been mentioned a number of times, They've already all worked on this deal. Patrick McHenry, Representative Emmer, they worked on this deal. So the Freedom Caucus members know what they can get out of it. So really, I think it is going to be a weak leader regardless of who it is, unless they go for this dream world land that Tom is talking about, which is you get a Democrats on board and you get an outside unity candidate.
Does this make the Republican Party more extreme or more moderate, considering that the moderates may have to work more closely with the Democrats to get anything done?
It's a great question. Libby Cantrell of PIMCO spoke to us about this yesterday when it comes to the debt ceiling. Everyone is talking about the fact that this just foreshadows how difficult those negotiations are going to be when it comes to raising the debt ceiling, and everyone is concerned about being on that cliff the way we were, say, in 2011. She's actually saying that a lot of these moderate Republicans come from Biden-won districts. And what they are going to want to prove more than ever after this absolute chaotic debacle on the House floor, being able to elect a speaker, which we have not seen in 100 years, they're going to want to show they are able to govern and that they are not paying fast and loose with the U.S. credit, with the U.S. spending. But she says that potentially this can actually show that those negotiations will be easier, but it remains to be seen.
AMH, I just want to set up the next hour with you when you come back, but just briefly, what's happening with Ukraine and Russia and this so-called offer of a ceasefire from Vladimir Putin?
Please don't read into this ceasefire. Vladimir Putin is being beaten on the battlefield. What we have seen in the Far East, most recently, Russia admitting that they lost 89 members of their military. That number was raised. And right now, he has suffered a number of defeats. This is a moment for Vladimir Putin to give in to this idea that because it is the Orthodox Christmas that they want a ceasefire, this is his moment to potentially restock and look at goods. And for the Ukrainians, if there are Russian military on their soil and they do not have territorial sovereignty, there is no ceasefire.
We'll continue this conversation in about 60 minutes. Looking forward to it. AMH down in DC. Anne-Marie, thank you. On this Payrolls Friday, if you're just tuning in on TV and radio, your estimate this morning is 202,000. The range is pretty big, looking ahead to the number we get in about 2 hours' time. But 202K is the number we're looking for. The unemployment rate expected to stick at 3.7%. And the overwhelming focus, I think, on Wall Street at the moment, at least, is going to be on wages. 5% is the estimate, 5.1% was the previous number.
And that, I think, is where people's eyes are. Although, that said, the headline number will be interesting, with Bill Dudley saying that it has to fall below 100,000 for several consecutive monthly reads in order to get to perhaps where the Fed wants to go. Wages will be some leading indicator of just how tight the labor market is and whether we're anywhere closer to that.
TK?
Yeah, I would go with that. I think it's a massive mystery. You know, as you mentioned at the top of the show, John, 200 up to 202. The wage dynamics will be great, but I just think it's a more nuanced thing than punditry certitude right now. As Steve Whiting would say, what about profits versus wages? That's an important dynamic. And I would also point out off the trade balance the other day, exports minus imports is compared to something we talked about 15, 20 years ago, domestic final sales, which is sort of the American interior economy. All this jumble staggers us out not to today, but gets us out to January 12th.
Do you think the pundits really have certainty right now?
I don't think anyone has
They're paid to have
certainty.
certainty.
On anything.
We believe.
Okay, they might say we believe, and then they say asterisk. We don't know what we're talking about because no one knows what's going to happen. I mean, honestly, that's what it's been like.
Brutal. I couldn't do it.
One of my favorite conversations at the end of last year was with Sarah House of Wells Fargo on what she called the final mile, getting inflation down towards 2% after the big moves we saw last year. And that conversation coming up next.
I started, I had no idea it was going to turn into this. This is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Two hours away from the payrolls report. Equity futures up by 1/10%. Good morning to you. We look like this across the board on the Nasdaq. We're just slightly negative here. We're down about 1/10%. Down on the week here on the S&P 500 by almost 1 full percentage point. Down for a 5th consecutive week. In the bond market, I have to say this bond market has not traded on the labour market data, which has been resilient this week because yields through Thursday on a 10-year down about 15 basis points. Now, maybe you can blame the ISM. It came in soft. Perhaps you can say something about the Fed speak. Whipsawed between hawks and doves. I've got no idea, Bramo, but people are lining up to buy bonds. Your 10-year, 372.72.
And that's on the long end. And here's really what my question is. If you take a look at the very short end, you have seen yields rising, and you see that yield curve inversion for the 3-month and the 10-month reaching the lowest since at least 1992. So maybe that's where they're sort of talking about it, but I get your point. Collision course right now. People aren't buying what the Fed's selling.
210s, -74 this morning. We'll build
That's
on that
underplay.
with Priya Misra.
The new steepness and the new greater inversion
do you
is
remember when Priya
underplay.
came on a number of months ago and she said -40 and we were like, wow, massive call.
Yeah.
-40, -50, and here we are just sort of relaxed and comfortable with this idea that we're at -74 on 210s. I'll get to that in a moment. I want to finish on this in the foreign exchange market. Just euro dollar. Had a bit of CPI data out of the Eurozone today. Headline CPI slowing sharply year over year, we're told. But if you look at core, sticky, elevated, still problematic for the ECB. Lisa mentioned earlier, about 30 minutes ago, you'll hear from Philip Lane, the chief economist of the ECB, a little bit later this morning. So look out for comments on that. Euro dollar just about holding on to 105 at the moment, 105.08, -0.1%. As I say, we're about 2 hours away from the December payrolls report. Jobs growth expected to slow to 202,000. Unemployment set to hold steady at 3.7%. Russ Kostrick of BlackRock weighing in.
It's industry by industry. And that is why this is such a difficult labor market. We're seeing softening in parts of the professional class. But if you look at other parts of the labor market, hospitality, restaurants, healthcare, these segments of the economy lost hundreds of thousands of workers during the pandemic that have never come back. They're still missing workers, which is why the quit rate is still high. And it's why the labor market may remain somewhat resilient.
As Russ Kostrick, Tom, still a pandemic labor market. Yeah, with a ton of new ones.
Well, this is you and I mentioned this yesterday. This is still the thing. Where are we in the pandemic right now? We're clearly in it. We're still, I believe it's under 400 killed a day, but the answer is a pandemic is statistically still valid. And yes, it's part of this economic story.
You've got these large companies that were able to hire, Amazon, Meta, through the pandemic, laying people off. Then these small and medium-sized companies that are still looking to hire. And that's reflected by the elevated job openings we're seeing across the country, Tom. Difficult to read. I think Lisa said it a few times this week, and I'm totally on board with her. If you've got a narrative, an argument, easy to make it right now because there's plenty of data to back up whatever you want to say.
Yeah, I'll go with that. Let's talk to somebody. You mentioned this earlier, Jen, somebody way out front in this a number of months ago. Great insight on the last mile, the last moment here of the American economy. Sarah House joins, senior economist at Wells Fargo. I love what you're saying, Sarah, your update into the new year. that we are hardly falling apart. I believe I read that in Economics 302 years ago. What does hardly falling apart mean?
Well, it means that we are seeing, I think, the jobs market softening to some degree. We see it in things like demand coming down, layoffs at least no longer improving if you're looking at the claims data. But I think when you step back and you look at where things are on an absolute basis, so just the overall level of demand, just how low we're still seeing layoff levels, this is still a very strong jobs market. And we can see that in a wide range of data, everything from the still very low unemployment rate to also still very strong and still very strong wage growth.
Go to payroll 101. John mentioned 202 as a number. I don't know what the 3-month moving average is with revision today. What is the run rate of a normal job growth for the non-farm payroll statistic? We used to be shocked when we said it was 150. Others have gone below that. Where's the Wells Fargo statistic of what the normal monthly growth rate is if we're not booming like we are now?
Well, it depends on what's happening in terms of that labor supply growth, so both participation and population trends, which are by no means favorable. And when you step back and you factor those in, so the Atlanta Fed right now estimates you only need about 85,000 jobs per month just to keep the unemployment rate at 3.7%, let alone, you know, if you see that needing to go a little bit higher in order to stomp out some of these wage pressures that are contributing to inflation.
Lisa? I've never heard that statistic before. Under 100 I've heard, but not 85,000 is a stunning statistic of where we are.
It takes a lot more work. It takes a lot more work in terms of decrease in the demand picture in order to get employment where the Fed wants it to be, perversely higher unemployment as they seek to combat inflation. Sarah, how long do you expect it would take at its shortest to get to a level that is more comfortable for the Fed, that perhaps there is a little bit of a dampening pressure on inflation coming from the labor market? How long does it take given the strength that we're seeing today?
So I think we'll see more market slowdown as we move through this year. So we are seeing firms curtailing those hiring plans. So if you look at the NFIB, for example, those hiring plans are the lowest we've seen since early 2021, only, you know, roughly on par with what we saw in 2019. So I think we're moving that direction. So some of the recent job growth has still been catch up in areas like leisure and hospitality, government sector payrolls, for example. But I think as we move further into this year, as the environment gets increasingly challenging with the high rate environment, with the clouds hanging over the broader growth outlook, you're going to see businesses get more cautious, particularly when that cost of labor is still pretty high. So I think that is going to put a dampener on the pace of payroll growth, you know, and we're going to feel it more, you know, probably around the spring, mid-year.
Even as people talk about recession in, say, the United Kingdom, we're seeing a series of strikes throughout the industries, in particular the railroads. In the U.S., on the peripheries, there have been a number of labor activity, organized labor movements. How much has that pendulum stayed in favor of the employee for the first time after so many years of the employer kind of having the upper hand?
Yeah, so employees are still in a relatively good position compared to what we've seen over the prior decades. I think some of that sway has weakened a little bit here in the recent months. And so I've heard from a lot of the clients that I've talked to, you know, they are seeing it a little bit easier to hire, a little bit easier to find quality workers. So they're not quite as worried about losing some existing workers. And so I think we're starting to see that come down on the margin. But again, stepping back and looking at where we are in an absolute sense, employees right now still have a lot of sway.
Sarah, sort of a philosophical question. One of the great things of the pandemic was the invention of $17 per hour, because all sorts of ginormous box warehouses need to put bodies in them. Is there a permanence to what Amazon and others did with these ginormous warehouses where they paid up and destroy the labor economy of the regions around them? Is that going to continue, or was that a one-off that drifts away?
Well, I think in terms of the long-term trend towards e-commerce, I think that's in place, even as we are seeing a little bit of a setback as you get the composition of consumer spending shift away from goods towards services. But I think it has left a more long-lasting mark on the wage picture. So if you think about a lot of the other industries that are having to compete against that lift in that wage level. So everything from your retail, but also things like daycare services. So those are industries that have had to really pay up in order to compete with these industries. And we know that, you know, nominal wages do not decline on net over time. So this is, I think, a level shift up, and that's going to keep wage pressures on a lot of other sectors, even as you see a slowdown in the e-commerce and warehousing industry.
Just quickly here, Sarah, we were arguing earlier on the show about the distance between 5.1% and 5.4% terminal rate in the Fed funds, the distance between going full Bullard versus full Kashkari. How different is that?
I don't think 5.1 or 5.4 is really that big a deal. I think it's more just how long that we stay around those levels. So I think there's, you know, we'll see. Time will tell in terms of whether we get there. But I think it's really more about just how long you see that very restrictive policy linger.
Sarah, you've been excellent. Thanks for being with us this morning again. Sarah House there of Wells Fargo. I think the Neil Kashkari of the Minneapolis Fed earlier this week in that blog post called it the second step of our inflation fight. Lisa, the second step of our inflation fight is keeping rates there, just pausing and waiting, and that's where the disagreement in this market and the communication between the Federal Reserve is right now.
I could not agree more, especially when Fed funds rates are showing rate cuts still for next year. If they keep the Fed funds rates at 5% for a year or 2 years, that is a huge difference than just getting there once for a couple months.
Your 10-year at the moment, 372.53. One stock to watch. You know this story so well at this point. Southwest in the pre-market looks a little something like this. The stock is lower by a little more than 1 full percentage point. You're well aware, I'm sure, of these statistics. Between December 22nd through December 29th, almost 51% of the total flights were cancelled by Southwest, according to FlightAware data. And this morning, they put a number on it. The estimated revenue loss, Tom, $400 million to $425 million. The company expecting to report a net loss in the fourth quarter off the back of this chaos over the holiday period.
Yeah, it's amazing to see, John, and I'll be honest, I haven't flown Southwest much, but this is part of the culture and fabric of Texas and a huge part of this country. This stock, John, is basically flatlined with this decline back 8 years. That's stunning. This is Southwest. This is like the profit center of the airline business, and that image has just been blown up.
There is going to be, Tom, a massive PR effort now over the next couple of months. And Lisa, we talked about it. Will you trust them if you need to get to a business meeting? Will you trust them over the winter period to get to wherever you need to go, a special holiday, whatever it might be? Trip. And how much will they need to adjust the price to make you take that risk?
Yeah, or give drink vouchers. I do think that it's interesting that Jefferies came out with this analyst expectation. Yes, you talked about a $400 million loss. They're talking about a figure north of $800 million, talking about $550 million tied to the cancellations themselves, but then an additional hundreds of millions of dollars to compensate people for the car rentals, for the hotel rooms, for all the lost travel when they were absolutely marooned during the holiday period.
And my reading of this from the unions, and granted they've got an angle on this, is simply they've underinvested in technology. On Wall Street, if you do that, you go out of business. Nobody's talking about Southwest going out of business, but what do they do? A whole new tech program to say we're not the old Southwest anymore?
This goes back.
That's what, 5-year project?
To something Lisa's talked about repeatedly over the last couple of months for this industry. Raises questions about the capital return programs over the last couple of years in a bigger way.
If this is a basic infrastructure of this nation, and that's how it's been considered, with all of these Congress members standing behind them and supporting them in a crisis, then can they continue to have the same kind of dividend programs? It's going to be a big question.
Stock is down about 1% in the pre-market. It is Payrolls Friday. That means we'll catch up with Tom Porcelli of RBC Capital Markets. I believe he is above consensus for payrolls, and that's where you need to be over the last 12 months or so. We've had 8 consecutive beats on the day on Payrolls Friday. Will we make it 9? We'll catch up with Tom in about an hour from now. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Kevin McCarthy's fight to become Speaker of the House drags into a 4th day. After a historic 11 rounds of voting, the California Republicans still couldn't lock in all the votes needed from GOP dissidents to hold the position. That's despite offering concessions on House rules. McCarthy and some of his supporters said they will press ahead with negotiations no matter how long it takes. U.S. authorities are ramping up the pressure on Sam Bankman-Fried's inner circle. Bloomberg's learned they are now scrutinizing one of his close associates at the bankrupt FTX crypto exchange, Nishad Singh. Now, Singh hasn't been accused of wrongdoing, and it's unclear if he will be cooperating with investigators or will do so. And it's a major shift in a Chinese policy blamed for exacerbating one of the biggest real estate meltdowns in the country's history. Beijing plans to dial back the so-called 3 red lines policy and relax restrictions on developer borrowing. Property firms may be allowed to add more leverage, and the deadline for meeting debt targets may be pushed back. Quarterly profit at Samsung Electronics fell by the most in more than a decade. That may mean that the global economic slowdown may be hurting electronics demand even more than expected. Samsung's operating profit plunged 69%. South Korea's largest company has been grappling with weak demand for memory chips, smartphones, and displays. Global news, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg.
We've gone all the way back now to the pre-inflation shock level of inflation expectations. Macro theories tell us that that bodes very well for the future of actual inflation. So this is a good signal for disinflation in 2023.
That was Jim Bullard of the St. Louis Fed.
The market right then
with the people yesterday. Look, he said exactly what Chairman Powell said in the news conference, which is we're getting closer to sufficiently restrictive. It was almost word for word precisely what the chairman had said in the news conference. And anyway, the market's going to do its thing. Equity futures unchanged this morning. And good morning to you on this Payrolls Friday. The S&P 500 going nowhere. Down on the week, unchanged on the session. Yields right now up about a basis point. Down on the week, up on a session. 372.53 on a 10-year. Euro dollar just a breaketh 105 right now. 104.97. We're negative 0.25%. As I say, core CPI a problem still in the Eurozone, even if headline CPI is fading just a little bit. So that's the story in Europe. Let's get to the story right now for Southwest. Putting a number on things for us. The stock is down by about 1% in the pre-market. It expects a net loss in 4Q, driven by a prelim estimated pre-tax negative impact of $725 million to $825 million due to the operational disruptions through December. Putting a number on those disruptions, Tom, cancelled more than 16,700 flights between December 21 and December 31st.
Unfair question. Did they get a bailout from the federal government during the pandemic? I mean, they all did, right?
Well, this is what Lisa and I were talking about.
Yeah, I know. I was listening.
The capital return programs of some of these firms over the last 3, 4, 5 years go back even further. And then you're coming out and saying, well, we underinvested in our infrastructure, and that's why they're getting a ton of pushback, Lisa.
So let's put a number on that. Southwest paid out nearly $10 billion to shareholders in the 5 years leading up to the pandemic because they had that much cash, and they used so much of it to reward their shareholders. The question is, why didn't they invest it in some of the basic technology that could have provided? Yeah. This is what the unions are saying, but there is also a question, and shareholders are saying that now too.
Full disclosure, British Air has the same problem. You know, my amateur take on what British Air's doing, they're no different. I mean, their system.
You know that you divorced BA.
I do. That's why I'm laughing, because I know that this is like a personal issue.
Yeah.
Do you want to tell us who you're hooking up with instead?
No, I don't think.
I don't fancy it, right?
You know, I mean, I have the advantage of the Gulfstream, and it's fine. But you know, I really haven't picked a new carrier. You know.
I thought you had.
Well, you know, I just don't think, you know, I don't think the public really cares what you fly or I fly. They do care what Lisa flies. I mean,
well, we know who Lisa flies.
Gulfstream.
Well, she got stuck in Atlanta.
Okay, all right. We don't have to get into that. Come on, look. I do think there is this question, particularly with low-cost airlines or those that are catering to families. How much pain are people willing to tolerate to continue to vacation? Yeah. And I think that is really going to ultimately be the question. Will it just take some drink vouchers, some free frequent flyer miles? No, that's what everybody is saying. Literally, like the small perks that you